Hey, good morning, everyone. It's 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman.
He's back.
Hey, we're back, baby. Here are three things that you need to know this morning. Tech took a hit on Monday with the Nasdaq looking for a bounce back this morning. Despite recent choppiness, stocks are still on track for a winning month and quarter. Despite this, the doomsayers are still out in force. We've got JP Morgan's Marko Milanovic warning of unknown unknowns, and now Goldman Sachs strategists are saying that any upside is likely to be constrained by high valuations and higher rates. On the latter, Morgan Stanley says expect a hike in July, with the bar for such a move now, quote, significantly lower. And Walgreens cut its full-year guidance as fiscal third-quarter earnings missed the mark on a weak consumer. The pharmacy chain CEO quick to announce moves to steady the ship. It's boosting its cost-cutting initiative to $4.1 billion. This marks something of a rare miss for the company. The last time that it undershot profit expectations was back in July of 2020. Despite the earnings miss, the business did see top-line growth with sales of $35.4 billion in the quarter. Its healthcare segment, that was a key tailwind there. And another day, another downgrade for Alphabet. Analyst fears that AI could be a growing threat to its dominance of the search engine market, seemingly piling up. Bernstein now downgrading Google's parent company, saying that increased competition will cap gains in the tech giant. It follows hot on the heels of a UBS downgrade on Monday. Equity research analyst Lloyd Walmsley citing medium-term revenue risk and a better risk-reward skew in buy-rated Amazon and Meta. Lloyd joins us this hour.
We're almost midway through the calendar year, and stocks defied expectations in the first half of 2023, but is there still room to run? Concerns over the Federal Reserve's rate hikes tipping the U.S. into recession have reemerged, however, with equity markets on the lookout for any factor that could influence the central bank's thinking. Goldman Sachs strategist Peter Oppenheimer says the upside in stocks is likely to be constrained as investor optimism over interest rate relief is premature. For more on what to expect in the second half of the year, we're joined by Anna Han, Wells Fargo Securities equity strategist, and Jonathan Boyer, the Boyer Value Group president. Guys, thanks so much for being here. Jonathan, I'm going to start with you and the resilience that we have seen in the market thus far, last week's dip notwithstanding. What happens now?
That's a great question. And, I guess you have to take a step back. In the beginning of the year, no one would have ever predicted that the S&P would be where it is now, as well as the QQQ. So it's pretty hard to make these types of predictions. But the one thing I would say is this is a classic example of why you have to stay fully invested, because you never know when the market will go up and will go down. It's better to take kind of a long-term approach. But if history is any guide, if you have a strong first half of the year, the second half of the year is also strong. That's going back to data from 1945, and this really shouldn't be much of a surprise either. If you look back historically, the third year of a presidential cycle is typically quite strong. No strategist going into the year would have expected this, but if you look back at history, it shouldn't have been unexpected.
But I guess the anomaly here is that we have never had a Fed that's been in a rate cycle pattern or rate hiking pattern at this point in the cycle like we've seen right now. And Anna, I guess from your perspective as well, does that mean even if the S&P 500, because to Jonathan's point, we've seen that move higher by about 13% year to date, does that mean that the rally is still on into the second half?
It's possible that the rally still has some legs. And you bring up a great point, Jonathan, that it's Fed path driven here. But something we keep in mind is what is really leading this market? Where's the concentration? And the lack of breadth is something we've had a lot of conversations on. So even if you say to be exposed to the market, really it becomes what part of the market do we want in our portfolios? And also, how much more can this AI-driven fever go? You look at really, it's been the top 10 names, maybe even 8 names in the S&P 500 that has led this rally. Even if the Fed decides to go another 25 basis points, which is what we expect in July, perhaps even 50 basis points is on the table for the rest of this year, it's very possible that that's not enough to really cool the market unless we really see something break the consumer. And so far, we're not seeing big signs of that in the data.
So putting all that together, and it sounds like you think that we could still see stocks continue to move higher from here.
I think it's possible. At the same time, something that we have noticed is because people are expecting the Fed to cut, though we don't think that it's going to happen that quickly, the expectation of yields probably coming lower in those Fed cuts have helped bring out a little bit of risk appetite. Now, risk appetite has been expressed also in a little bit of a rotation that we've seen into more small cap space. So if we see that rotation gain some momentum, we might see large cap stall out, move sideways. We might see a little bit more life breathe into the small cap, mid cap space. So that's one possibility, and that's what we're looking for.
Do you also think 50 basis points through the end of this year? BIPs? I just love using the word BIPs sometimes.
Yeah, it's a nice word to use. I really can't comment on that. Who knows what the Fed is going to do? What they say and what they do has been very different if you look back over the last year or two. But to Anna's point, I think the best area to be in is in small caps right now. It's by far the cheapest area of the market. If you look back over the past 5 years, the Russell 2000 has basically done nothing, which is, and it's underperformed larger caps by about 7% per year. You look at the S&P 500 equal weight, which has more of the smaller names in there. It's down. It's up only about 4% this year. So that's the area where there's opportunity, as opposed to these large cap names that, for the most part, are pretty overextended.
Well, opportunity is all well and good, but something has to change in order for, in other words, that underperformance could continue unless something changes. What would change to catalyze those small caps, for example, Jonathan?
Well, it's valuation, but as to your point, valuations have been cheap for a long time.
And valuation alone isn't usually a catalyst, right?
It's hard to tell what the catalyst will be. No one would have thought there would have been a banking crisis in March, so it's hard to tell. So if the best prediction of future returns is valuation. So if you can just stand the pain and not have the try and go for instant gratification, I think people over the next 5 years will be very happy that they invest in kind of smaller cap names. And I think it pays to be selective because, especially in those areas, not all names are created equal.
And Anna, small caps right now, or do you remain defensive? Where are you kind of overweight or saying that there should be the most focus in an investor's portfolio right now?
Well, we haven't actually been that defensive in our portfolio, at least not in the traditional sense. We came in the year long, media and entertainment. And while we did ask investors to trim the volatility in their portfolios and be conscious of having some low vol exposure, or at least avoiding high vol exposure, we weren't looking to be in the Utes or REITs or staples space. And something that Jonathan mentioned is you have to be selective down the cap. We know it's a riskier play, but something that might change as well, in addition to valuations and traditional fundamentals, look at the technicals of how much the Uber caps, or you can use as a proxy, the Russell top 50, have outperformed the basic broader market or the S&P 500. When you look at how that's done over a 5-6 year basis, you've seen that it's hitting its technically overbought levels. And that is also another signal to add on to Jonathan's point about valuation, why maybe it's time that small caps can have its chance in the sun here, or at least that we see a little bit of losing steam in this fever of these very concentrated biggest names leading the market.
All right, let's hold things there. We've got to take a look at the state of retail and the consumer here. We're watching Walgreens stock as it falls in pre-market trading. The pharmacy giant reporting third quarter results, beating on revenue but missing analyst expectations on earnings for the first time since July of 2020. Walgreens also slashing its full year earnings guidance. That's now looking for a range of $4 to $4.05 per share for the full year of 2023 versus $4.45 to $4.65. That was their previous outlook here. So a few things that, of course, for us to remember about this company when they do report, it's also not just the healthcare segment, but also that retail segment. And that's where you can see a little bit of choppiness, perhaps, in where the consumer is purchasing within some of the stores.
Well, the company, it's interesting at this stage, but the company is really calling out COVID-related services at this point as being an area of shortfall. And I say it's interesting at this point because here we,
like a year removed from everybody going to get vaccines.
In other words, of
Walgreens.
course you're seeing a drop in demand for this stuff. So it's interesting that it wasn't sort of more modeled for, I guess. But at the same time, CEO Roz Brewer in the statement also talked about a more cautious and value-driven consumer. And she said a recently weaker respiratory season created margin pressures in the quarter. So what's good for all of us, I guess, is not necessarily good for Walgreens. In other words, people didn't get colds as much, right? I guess is what she's saying. And so that means that it wasn't as strong for the company. They're doing their conference call now, I believe, and accompanying that was a set of slides. So they actually gave a forecast for the full year, excluding the effect of COVID and FX, which is interesting, and said that adjusted earnings per share will be flat to up 1% if you exclude those items.
Yeah, particularly interesting for Walgreens as well here is, I mean, the companies in the wave of consolidation that we had seen roughly 2017, early 2018 within the healthcare landscape, trying to merge some of the PBMs along with healthcare insurers, that was to make sure that when more people lean into insurance, essentially it's kind of a barbell approach where you've got the retail on one side that will do well as a standalone in times where consumers are gleeful or at least continue to spend in that retail side of the business or on the pharmacy side as well. But then additionally on the insurance side, being able to take advantage of a time like this where more people are opting into getting the elective surgeries that they did not get or having more of the routine check-ins. So leaning more into that insurance side. But for Walgreens, they don't have that same type of add-on exposure or at least benefit that some of the other PBMs had strategically been able to kind of put together some landmark deals around. So that particularly interesting. You'll see where they have to kind of net out some larger insurance deals going forward from here. They mentioned one with Blue Cross Blue Shield, but again, I mean, these are still some of the partners of theirs rather than being owned entities.
Yeah, exactly.
Well, Walgreens cut its full year guidance following CVS footsteps last month, reflecting higher costs and a pullback in consumer spending, hitting several retailers this quarter. So what does this mean in this forecast for next earnings season? We're bringing back in Anna Han, who is the Wells Fargo Security Equity Strategist, and Jonathan Boyer, who is the Boyer Value Group President. And I'm going to go to you first on this one. What does this foretell, perhaps, for where the next quarter of earnings should set in or at least kind of push expectations from the investors?
Oh, we'll say it's still early in the season, but something that I think they specifically mentioned is that the consumer is becoming more price conscious. That's been a trend we've been seeing, and we think it's going to continue. And what we've seen with top line margins, top line sales has been that it's been declining on a quarterly basis at a much more rapid rate than I think a lot of the consensus on the street is expecting. So if that continues, you can imagine how much is already declining on the top line. We continue to see margin compression. So that bottom line earnings number that corporates are able to take home has been shrinking faster than a lot of the consensus has projected for this year. So it makes us bring back to our conversation that Jonathan and I were having earlier about valuation. How can this market continue to trade on such a fat multiple when you're seeing that the actual EPS value that should be driving the market is shrinking faster? So our outlook really is that we're cautious on earnings. We do think that the earnings decline, or perhaps I would say, quote unquote, earnings recession, comes before we see that GDP recession.
Well, I mean, the stuff that's trading on a fat multiple, the earnings look a lot better. I'm generalizing, right? But I mean, something like Walgreens doesn't have a fat multiple, right? It's pretty cheap, and I guess you could say maybe justifiably so. So I guess in this market, Jonathan, how do you find something that is actually growing but is cheap?
That's the billion-dollar question.
Yeah.
I mean, that's one of the reasons. To your point about insurance companies is why we prefer CVS over Walgreens, because it has that kind of anchor, although they've had some unforced errors over the past year. But you're now buying a stock at 8 or 9 times earnings that has a nice dividend yield that's delevering. So there's a lot to like on the story. But it is interesting, their comments. I wouldn't extrapolate it to everyone that the consumer is trading down or is being more budget conscious. But you just want to buy and look for good companies that have good value that people want to spend money to, like a company like, let's say, Topgolf Callaway Brands, which we talked about last time I was on the show, is
he wants to spend some money there. I know that.
Oh, it's a great experience. Top notch.
Top notch.
Topgolf.
And it's also a cheap stock. And I was there this weekend. You spend. It's a great business. It's growing. Same store sales are up about 11% per year. The stock is trading like a golf equipment maker instead of a fast-growing entertainment concept. So you just have to pick your spots, and you don't have to buy everything. And sometimes you get what you pay for. You have to be very careful. I wouldn't want to have a portfolio just consisting of 8 times earning stocks, because you're going to get a lot of broken stories.
Do you see any recess or at least receding in the resiliency among consumers that we've been hearing about over the course of last earnings season?
We've been hearing this for quarters, and right now you still have a very good employment picture. People are spending money. They're spending money on different things. They're spending money on experiences. Companies like Liberty Braves that we like, Atlanta Braves baseball team. People are still going to the ballpark, especially because they, unlike the Mets, are doing well.
and on this front also, it's interesting you talked about you guys like TMT stocks, telecom and media here. Is that something you continue to like? That's sort of the other side of this coin, right? People staying in and streaming maybe instead of going out and spending on various events.
Well, I think there's a mix that you see in that TMT space, specifically for us, why we prefer the media entertainment. So we think the valuations there, even though it's had a great performance year to date, almost keeping up with the QQQ, is that the valuations are still a little more reasonable than you see on some of the other parts of the tech sector. And it has this combination of, there are these experiences parts. It's not necessarily only tied to staying in, but it's most of the experiences versus having these durable or hard goods. At the same time, you're getting this combination of, you get that AI flavor in there. There's a lot of this exciting new technology, machine learning that these kind of companies are using. So a way to get exposure to that rather than chasing what you might have feel like a train that's already left the station is to look into that media and entertainment space. But I think the broad theme that we need to keep in mind here is, what is the consumer trend? Even as you go or expect a recession, or even if you expect some of other parts of the consumer to remain perfectly healthy and continue to spend as they have, then you need to think about what has changed post-pandemic and what's the consumer spending going to look like for the next 1, 2, 3 years. And that's going to really help guide the kind of sectors that you want exposure to, and find what is cheaply valued, but not cheap for a reason.
All right, hang on, you guys, because we want to continue the conversation. Anna and Jonathan, stay with us. It has been a muted, if not slightly negative, past few days for markets. Big tech companies that soared earlier this year, like Microsoft, Nvidia, and Tesla, slumped on Monday. And after a string of wins, stocks are facing their first possible losing week in a month, when we had a losing week last week. To discuss how to best play the market's possible cool down and to talk about volatility, we're bringing in Jonathan Boyer, Boyer Value Group President, and Anna Han, Wells Fargo Securities Equity Strategist, who are both still with us. And I really want to focus on the low volatility side of the equation. Anna, you mentioned earlier looking at some low vol strategies here. A, why is volatility so low right now? And B, what do you do about it?
When we looked at low volatility strategies coming into this year, it was still when we were pretty uncertain on how this hard landing or soft landing scenario was going to come out. And there's still a lot of fear in the market. So you saw that risk aversion was one of our quant factors that continued to outperform for February to April. And now it's been interesting as investors have had this sudden mentality shift of, maybe we can achieve that soft landing. Maybe the Fed won't go too crazy or over tighten. And that kind of hope has helped bring a little more bid to risk, something we talked about with that small cap rotation. But what's also suppressed a lot of the equity vol here has been that inspiration, has been that hope. And it's also been that the market has been grinding higher, led by just a few names. That grinding higher has brought a lot of implied volatility in the front end of the volatility term structure lower. It's also made skew a lot flatter. Skew, when we talk about in the front, is thinking about how much are investors buying downside protection versus upside exposure. And there's not that much exposure to the downside. So if people aren't buying that much protection, it makes it cheap to buy that downside protection and becomes more perhaps valuation worthy of looking into it. In particular, if you think that there could be a little bit of a pullback, maybe as these AI names lose a little steam, maybe as we see that rotation into small caps, and also as we get to month end, you might see some money come out of equities. So these are all the things we think about when we look at the vol markets and try to assess whether volatility is cheap enough to look for those hedges.
Yeah, Jonathan, Anna through the alley, so I'm going to try and complete the oop here. When it comes down to who is responsible, what part of this kind of broader calculus is responsible for the volatility that we're seeing? Is it solely the Fed, or is it also just the overhype in AI, as she was mentioning a moment ago?
I think it's both. I mean, I think there's a mania, or it's not quite a mania, but up there with a mania on AI. Obviously, everyone's nervous with the Fed, and then there's FOMO. You're seeing now people are putting money into the market after after the market's up 13-14%, and as measured by the S&P. So you have a lot of reasons why the stock market could grind higher. But the question is, will the first half leaders be the second half leaders? I don't think so. But I think small cap will lead either in the second half or the beginning of next year, and that's where investors should be positioning themselves.
Do you think that AI kind of rug pull, if you will, happens in the second half of this year?
You never know. I mean, you look back at 1998, 1999, that lasted a lot longer than anyone ever would have expected. Microsoft sold for 50, 60 times earnings. Cisco was, had a 3-digit earnings multiple. The question is, and I'm not saying it is NVIDIA the Cisco of today? And maybe it is. You know, they got the concept right, but the valuation was just way too expensive.
Sort of on a related note, and sort of looming all over this, over all of this, and all over the volatility discussion, is what could go wrong in this scenario, right? And Anna, I want to put that question to you because I think of summer in particular as a time when things go wrong, right? People are out at the beach, the volume is low, there are shocks in the system that kind of tend to happen in the summer. What would be your nominees for shocks this summer?
No, you're absolutely right. Liquidity in the summer can slow down, and that can lead to some surprise moves. It can lead to some gapping, especially when everyone's trying to take that summer beach vacation. So something we've been looking at has been quoted as we have looked at the issue of what happens if these student loans get knocked down in the Supreme Court, and if we do see student loans have to start again. Now, on a broad basis, we don't think it breaks the back of the consumer, but it certainly could cause a lot of pain for some of the households that have been a little more debt heavy. And in particular, one part that you look in the economic data that you see auto loan delinquencies have been rising for a bit of the younger population, the under 30, under 40 group. And that's also a group that tends to hold most of the student loans. So you see that kind of combined, there could be some pain points there. And that could actually have an impact on equities. But broadly speaking, so far, we think the risks here are that people are under hedged. And so when you see a pullback in the markets, when people are under hedged, it's a surprise. There's a bit of a scramble to try to get that protection or try to de-risk. Now, these are the kind of things that can feed upon themselves in a low liquidity market. But, these are very much tail risks. And so far, we still believe that the market could really be trending sideways for a while and prefer to look for that opportunity that's more valuation attractive in that small cap space.
In a sideways trending market, where are those opportunities on the valuation front?
Well, I think stocks that have catalysts, you have to go on a stock-specific nature. I had mentioned Liberty Braves, for example. They're about to spin out, do a hard spin. It's a tracking stock. It's going to be an asset-backed stock. It's going to happen in the next couple of weeks. That could propel the stock higher. You have stocks like Howard Hughes Corporation, which Bill Ackman, the hedge fund investor, is chairman, owns 33% of it, keeps buying it every day. So there's kind of an Ackman put, if you will, in the stock. So you have to, if you do your research, you do your homework, and you know your names, these type of things shouldn't matter. And I think investors should stop trying. There's always a reason not to buy stocks. And if you told me at the beginning of, or told an investor at the beginning of the year, you're going to have a banking crisis and a debt ceiling showdown, would you want to be in the market? Probably not. And look what you would have missed. So I think investors should stop really focusing on what could go wrong and look at company by company, and do you want to own these things?
Maybe buy a little insurance, as Anna suggests as well, if you're going to do that. Maybe. Anna, thank you so much. Anna Hahn, as well as Fargo Securities equity strategist. Jonathan Boyer of the Boyer Group is going to stay with us. You're watching Yahoo Finance. I guess on my short-term wall of worry, it's not so much a wall of worry as a wall of questions, right? What is the Fed going to do? Is the U.S. economy going to go into recession? How severe will it be? When will it happen? And then I have like a longer-term wall of worry, which is how is climate change going to affect the global economy, for example? Who's going to be president of the U.S. next time around? But That's a much taller, longer wall of worry, I guess.
Two walls of worry for me. One, I'm very sunburned after my coverage of Cannes Lions with our very own Brad Smith. A lot of big name guests. You can see my head is very much peeling, not a good look. Number two, I need about 35 more guests for Yahoo Finance's big fall conference. That is being held on November 7th at Moonlight Studios. We need about 35 more big name CEOs. Hopefully we'll get them soon.
Small cap stocks have been largely left behind in this year's market rally as AI and big tech have dominated the conversation. But as things pick up steam, yes, some of those smaller, cheaper names are starting to join the fun. For a deep dive into these small cap stocks, we are bringing back in Jonathan Boyer, who is the Boyer Value Group president. Jonathan, all right, walk us through some of these small cap stocks because we were discussing Russell 2000 before this segment, but where within the small cap stocks are there particular themes that are emerging right now?
I think, there are certainly themes, but I think it's important to do a stock by stock basis. But let's say one theme is publicly traded sports franchises. We discussed in the previous segment, you have Liberty Braves, which are going from a tracking stock to an asset-backed stock. It's controlled by media mogul John Malone. It's trading about $39 a share. We think it's probably in a sale worth the mid to high $50. He is not an emotional owner. It is our belief that he will sell the team at the right price. He's not the kind of guy who's buying a team to sit on the front row and watch the game. He's a capitalist at heart, and I think he will, shareholders will be rewarded. And then you have, being in New York, you have the Madison Square Garden Sports, which owns the Knicks and the Rangers.
But there you do have an emotional owner, don't you?
A little bit, a little bit. But you have to remember, if you look at the history of the Dolans, they bought Madison Square Garden, which included the Garden, the Knicks, the Rangers, everything for a few $100 million. So they're savvy people. We were investors in Cablevision and did quite well. And he sold it for a price that we never thought we would get. So our bet is at some point in time, he either sells the entire team or he sells a stake in the team, which has become increasingly popular as you're seeing these private equity firms and sovereign wealth funds come into the fold. And that helps put a valuation on the teams. Right now, the enterprise value for the Knicks and the Rangers is $5.5 billion, which is ridiculous. The Knicks alone probably would go for over $8 billion in a sale.
Imagine if their record was better.
Yeah.
They had a pretty good year this year.
Yeah.
But yes, it's been if you're a Knicks fan, it's been a long 2 decades.
Oh my goodness. Well, yeah, that's unfortunate for you guys who are rooting for the Knicks still in the year of our Lord 2023. As we think about the small cap stocks right now too, is there more pickup among institutional versus retail from what we're seeing in the volumes and the inflows?
Yeah, I mean, I think for the institutions, they're probably for the most part buying the actual index.
Yeah.
But for those stock pickers, people are finding ideas, and eventually people will flock to valuation. But a lot of these are ignored. One of the names that I mentioned in the last segment is Howard Hughes Corporation, which is controlled by Bill Ackman. Only 5 analysts cover the name, so it's not like the most widely.
A mall owner?
It used to be part of General Growth Properties, which was spun out, and that was one of Ackman's biggest successes. He now controls Howard Hughes Corporation, which really owns master plan communities, some developments in Hawaii, as well as the South Street Seaport. And he just, he had a tender offer earlier this year for a lot of shares. It was undersubscribed. It was subscribed. People, he just keeps buying back stock every time it hits 75. So there's that Ackman put there, and we think it's selling at a significant discount to NAV. And over time, that discount will narrow, and it wouldn't surprise us at some point in time if he has a publicly traded vehicle in Europe if he merges the two.
It's really interesting. The names that you've mentioned, all maybe coincidentally, are closely associated with big characters. Malone, Dolan, Ackman. Is that a coincidence? Is that something you kind of look at to see what the advantages and disadvantages of that kind of ownership are?
I think Dolan is in its own category, so I think we like to invest alongside, owner operators or people with a lot of skin in the game. Malone hasn't had the best decade. A lot of his names haven't done as well, but historically he's been a great person to invest alongside of. But we want to invest along with great assets, and all of these companies that I just discussed are trophy assets. And at some point in time, value will be recognized, and you have a margin of safety there.
If only they could win a trophy, those Knicks. My goodness.
Jonathan, good to see you. Thanks for coming in. Jonathan Voyer of the Voyer Value Group. Thank you.
Thanks for having me.
Well, we had the opening bell on Wall Street, so let's do a quick check on markets. Turning it around a little bit today, although we did have some up and down in range activity yesterday. Right now, out of the gate, we've got the S&P gaining about 1/3%, the Nasdaq up as well, the Dow rising about 0.2%. And we do have a comeback in some of those large cap tech names. Brad Smith is back on interactive duty, back from the sunny shores of the Riviera.
Yes.
To the interactive.
I know. It's almost similar, right?
It's so similar. The lights on your face, do you feel like?
It hits the same way, and it doesn't affect my skin tone as much, so that's good. The markets have opened, so my Nick slander concludes now. The Dow Jones Industrial Average, you're seeing that higher by 0.2% out the gate this morning. The Nasdaq Composite, you're seeing that over the past 2 days down by about 0.8%, but this morning up by about 0.4%. We'll be generous and round that up too for the tech-heavy average. And the S&P 500 out the gate right now higher by about 0.3%. So the hat trick, triple, double, trifecta, whatever you want to call it up across the board. Let's take a look at some of those sectors in the 11 S&P 500 sectors as we pull them up here on our heat map. We've got a good look at what's moving, what's grooving here intraday out of the gate. Energy bringing up the caboose. It's down 0.2%. However, take a look at consumer discretionary here. That's up by about 0.8%, and leading the pack for the 11 S&P 500 sectors. And speaking of some of the other hot spots in the market here on the day, the hot spots are not the ones denoted in red. Unfortunately, you're seeing, of course, as we were talking about Google or Alphabet earlier, and some of the wavering of confidence within that name, at least regarded to or related to some of the AI ambitions that the company has. You're seeing some souring on the street, and Alphabet, another analyst rating, has moved them lower here today. That's down by about 1%. However, you've got some hot spots in green. Microsoft, that's up by about 1.4% out of the gate this morning. You've got Apple, NVIDIA also up by about 1.5%. Tesla and Meta also seeing some solid gains there. So that is the mega cap tech stock. And then just lastly, rounding out this roundup, if you will, retail. Taking a look at retail here this morning, given the fact that we did have consumer discretionary moving, leading the 11 major sectors of the S&P 500 here this morning. Just wanted to take a quick look at some of these retail names. You've got largely green across the screen, except for some of the southeasternmost companies here in our heat map, trying to give it a little bit of a map approach geographically here, if you will.
Yeah, I like that. Southeastern weakness there in the heat map.
Now we've just made it southern.
Yeah, I like it. All right, Brad, let's talk about some other movers here, including shares of Delta. The shares up by 1.5% or so after the company raised its earnings guidance for 2023, as well as its outlook for total free cash flow. Delta noting in a presentation ahead of its investor day that strong demand and trade-ups to more expensive fares are driving growth. That is a surprise for me personally.
It's happening.
It's happening. People trading
it's
up.
Happening. Yes. In your experience, you want to make sure that you get the best beverage experience when you're in flight, and especially
is that what they mean by trade ups?
Premium.
I guess.
Yeah.
Or is it also like, non-stop versus stops, better times that are a little more expensive? I don't know.
I think it really is in seat, as people are now taking some of the longer trips that they have put off because of the pandemic, or because they were looking to save up for that trip, perhaps even. Now, as you're on that 6-hour flight, are you going to pay up for a little bit more of a Delta Premium Plus? You probably will. You want the leg space. You want the free drinks. You want the...
Why do I get the feeling you're just speaking for yourself? When you say you want the leg space, you want the free drinks, I think Brad means I want the... See, me...
It's me looking in the mirror and I say that.
I don't need the leg space. You need the leg space more than I do.
I do. I really do. It hurts.
Sure.
It hurts. But the spend shift to services, that's certainly continuing and helping the company here. They denote this on page 8 of their presentation here today, saying that the spending on services is still not fully recovered. That is a boon to Delta. Also, the long-term shift to spending on experiences, if that remains intact and there's more of a prioritization of spending on experiences or services in that regard versus spending on the goods economy, then Delta Airlines, United Airlines, American Airlines, keep an eye on some of those companies, as well as where in the upgrading of some of those service experiences they may be beneficiaries, perhaps.
Interesting. I'm going to have to think about these things next time I book a flight.
Okay, so the leg space aside, you get the good meals, you get like the drink service and...
No, I bring the stuff on the plane with me usually.
Yeah.
Because usually it's not just that you're paying for the food on the plane. It's not always. It has gotten better, but the selection's not great. I don't know. I'm going to do some market research because I am doing some upcoming traveling.
Really?
And I'll report back. All right, let's talk about some other movers. Snowflake and NVIDIA are teaming up with each other, bringing the chipmaker bringing its AI platform to Snowflake's cloud. Stocks for both companies are rising on the news. The partnership's going to allow businesses to create customized generative AI applications using their own data, all within Snowflake's cloud. It's interesting, Snowflake yesterday said it was going with Microsoft in terms of its AI offerings as a partner, and now today, or I guess late yesterday, making the announcement about NVIDIA as well. Yeah,
I think one of the key acknowledgments that they had within the release, as well as where this entirety of generative AI will continue to move forward, it comes down to the data. They said that data is essential to creating generative AI applications that understand complex operations, the unique voice as well of every company. And for a lot of the Salesforces of the world, the SAPs of the world, Snowflake even. If you're looking across this ERP landscape, what do they have in droves? It's data. And so as they're kind of looking across these collaborations and for enterprises where there already is a strong portfolio client base that a Snowflake might have versus an NVIDIA with just the amount of purchasers, because there is more of a reliance on a cybersecurity front layered onto what your data center might have. NVIDIA now is going to have access into a totally new cohort of potential customers because of partnerships like this, as well as Snowflake being able to up the service that they do offer, perhaps if NVIDIA and Snowflake are successful with this partnership and the high performance kind of machine learning that can go forward with some of the data that they already have.
The little bit of analyst commentary I saw this morning wanted more details on how exactly this is going to work, what the offerings are going to be.
Revenue sharing even.
Yeah, I guess this is all ahead of Snowflake is having a summit right now, so maybe we will get some of those details now. Yeah. And maybe we'll have to wait for some of them as well.
Snow at the summit. We like it. All right, guys, let's also talk a little Lordstown Motors. That stock taking a beating this morning after the EV truck maker announced it was filing for Chapter 11 bankruptcy protection. The company is also suing Taiwan-based manufacturing giant Foxconn Technology. And joining us now with more on this, we've got Yahoo Finance reporter Josh Schaefer. Josh, what do we know?
Yeah, Brad. So Lordstown Motors, as you said, filed for Chapter 11 bankruptcy today, also suing Foxconn. Remember, that's the Apple iPhone maker. That's what we most commonly know Foxconn for, so that's why that's very notable. And really what happened here is Lordstown Motors has not been able to sell a lot of vehicles. They've been struggling. They had sought out Foxconn for funding, and they're saying Foxconn never gave them that full funding. Foxconn argued, well, the stock price went down too low, so we didn't owe you the money. That will be played out in court, but it's going to be interesting to, again, see that iPhone maker have to go to court with an American company, a Taiwan-based company there, going to court with an American company. And I think the interesting thing with Lordstown, when you zoom out, bankruptcy, you always think, what are the assets, right? So they have that endurance pickup truck that is a certified vehicle in the US that they have delivered, and they have a plant in Lordstown, Ohio, that someone might want to buy, that is an operational plant, that an up-and-coming EV maker,
well,
or even an
Foxconn owns it now, don't they?
I think, but I think that would also be what the court case is about, right?
Yeah,
so then if they were, right, so that would be, we're spinning it forward a little bit, but potentially Foxconn might not own that, depending on how the court case goes, right?
Oh, I see. Because they did buy it as part of this whole deal. Right. Foxconn, if they do end up keeping it, they could use the plant, right? I mean, you know, one of the threads we were talking about this morning in our meeting is that obviously there are stakes here, not just for Foxconn and for Lordstown Motors, but for the town of Lordstown itself, which was. The whole prospect was like revitalization of this town. And now there are a lot of questions about what the future looks like for them.
You know, it was a promising, I mean, you remember former President Trump was saying Lordstown Motors, this is a great moment. They introduced the truck on the White House lawn. That was just 2-3 years ago now. And now you're seeing this company file for bankruptcy. I also think there's an interesting stock story here too. When you think about a 2020 SPAC IPO that was trading at over $400 per share, you take a look at that max chart, now it's down below $2. I mean, they only had 188,000, 189,000 in quarterly net sales in the most recent quarter. So they never really materialized as a company, which I think is always interesting when you think about these SPACs, these IPOs, what are they actually doing from a business perspective when you're buying those stocks?
Well, that was part of that whole enthusiasm that we had, not just for electric vehicles, but for autonomous vehicles. I think of Argo AI, which also filed for bankruptcy, one of those early players in the AI business, and you had some others that came public through SPACs, right, that also saw surges at that time. And now, as time goes on, I mean, you have to think about that as we look at the AI situation now.
Right.
And whether they're going to be, I mean, whenever you get a hype like that,
Yeah,
a bubble. The bubble always pops.
There are some that don't survive.
Yeah,
exactly.
Well, interesting to track the ride that Lordstown has been on over this quarter. I tried. Look. All right. Josh, thanks for joining us. Appreciate it. All right, plenty more ahead. You're watching Yahoo Finance.
Always causes a summer of chaos, it feels like, right? There's always like a thing in the summer that makes markets kind of go a little bit wacky. The Fed is as good a guess as any.
The Fed is definitely right on the cusp of causing a summer of chaos, because that's what they do when they're trying to solve complicated problems. So what does a summer of chaos exactly mean? Well, we might be about to find out. It might mean a sell-off in hot AI stocks, might mean a sell-off in Google. Whatever it is, you can blame the Fed.
Welcome back, everyone. Let's get the market action with Yahoo Finance's Jared Blickery, who's over at the New York Stock Exchange, just paces away from that buttonwood tree. Jared.
Yeah, you know, I would love to see that buttonwood tree. Would that it be still around someday? I'm looking at the Wi-Fi Interactive and just kind of reflecting on the month, because this is capping a really productive first half of the year. We see the S&P 500 up 13%. And in the month of June specifically, we saw this rotation, and it gets back to that non-farm payrolls that we saw at the beginning of the month. That was the May numbers. And you can see right here, volatility. Here's the VIX with a year-to-date chart, drop below this previous floor level. That was on that NFP day. And just pricing in a little bit of a different picture here. I said at the time, good news is good news. You can see the same thing reflected in the ICE B of A move index. This is a VIX of bonds. But anyway, in June, we saw this move lower as well, with the net effect that we are up almost 30% in the Nasdaq. But finally, we're seeing some other sectors claw back some of those losses from last year. Here's a 5-day look at the S&P 500 sectors. And what you'll notice is that at the bottom here, we see the mega cap sectors plus financials. Those are leading the way down over the last 5 days. But we do see some green in staples, materials, energy, even industrials, although it looks like it's about break even. And that was where we saw this surge a month ago. And in fact, over the last month, you can see consumer discretionary, XLY, that's retail, up the most, with industrials and materials. So that's a decent mix right there. And you take a look at the leaderboard over the last month, Bitcoin, that's in the other left. That came back roaring strong to the 30,000 level. XHB, by the way, home builders just set a record yesterday. Only yesterday did they close at a record high, another one. So strength, at least in some parts of the housing market, and optimism right there. Meme stocks getting some love, ARC, IPOs, transports, Chinese stocks, and retail. All of those getting some love here. And while we're on the topic of China, I just want to go over, move overnight. They devalued the yuan. They have various methods at the PBOC of juicing the economy, and one of them is devaluation of the yuan, and they can do that on a blanket basis, or they can do it on a day-by-day basis. When they achieve their fixing point, they can set that north or south of what the market expects, and they've been trying to strengthen the yuan with the net effect that China is looking up. You can see on an intraday basis a lot of green on the Wi-Fi Interactive here, but you take a look at the currency longer term. Let me just get to our currency board here, and I'm going to show you a different story. So as we are looking at this, up means a stronger dollar and down means a stronger yuan. Here is what we're looking at this year, and you can see that rise over the last 2 months, up 4.5%. 7.2, that is approaching historically very significant levels. I'm going to put a 20-year chart on here. You can see we've seen this level in years past, and if we break above, that could be a material weakening in the yuan. That would be good for their exports, and maybe that would juice their economy, but there's all kinds of political implications when we start having this competitive race to the bottom when it comes to currency devaluation. So that's my 2 cents there in terms of Forex land. But all in all, I was looking at some of the Nasdaq stats, very strong beginnings of the year. This would be the third best one. And as some other people I follow on Twitter are noting, the best 2 years in the Nasdaq for the first 6 months saw terrible second halves of the year. So you can make the case that it would go one way or the other way based on how you slice and dice the data. But if you come 30%, you got to think that maybe, just maybe, tech is due for a little bit of a pullback here. Overall, as I've been saying, as long as the market continues to rotate into some of these other names and sectors, that is healthy.
We'll see if it keeps going. Thanks a lot, Jared. Appreciate it. Another day, another downgrade for Alphabet. Analysts fear that AI could be a growing threat to its dominance of the search engine market. Bernstein today downgrading Google's parent, saying increased competition is going to cap gains in the tech giant. It follows hot on the heels of a UBS downgrade on Monday. Equity research analyst Lloyd Walmsley there citing medium-term revenue risk and a better risk-reward skew in rivals Amazon and Meta. Lloyd's joining us now to talk us through his call. Lloyd, thanks for being here. So why, when you're looking at the sort of competitive landscape, or at least the competitive menu of where you want to put your money, do you think that Alphabet is not as attractive?
Yeah, it's a couple reasons. I think at the heart of it, the risk reward looks better to us at Meta and Amazon. So if we look at what's going on at Alphabet, they're integrating generative AI, there are likely to be benefits from that to them longer term, but there are also headwinds, right? The new SGE experience with generative AI, at least initially, appears to be pushing ads further down the page. So there may be some short-term revenue headwinds. Over time, they probably figure this out, but it's not totally clear. And then there's also some competitive concerns. We're less concerned about Bing and ChatGPT, though there's still slight risk there. But you also start to see Snap and ultimately Meta will move into chatbots, which have search-like behaviors and potential for search-like advertising. So there will potentially be some fragmentation on the query share and then some disruption on the monetization share. You look at something like Meta, on the other hand, and the stock, for starters, it's trading at 17 times earnings as opposed to significantly higher on Google. We think growth can be faster at Meta. And then the AI story there is not really well appreciated at all. And we think that they can generate as much as $7.5 billion in a bull case on the Facebook app alone from a generative AI chatbot experience. That's likely to hit Instagram and WhatsApp too. And this is much more incremental to Meta's business, whereas Google, what they're doing is kind of investing to stay in the same place. There may be some offensive side to it over time, but in the near term, there could also be some headwinds. There are just more questions, and with the stock hitting our old target and kind of not enough upside on our new target, we stepped to the sidelines on the stock overnight, the night before last.
Lloyd, I guess what I continue to take issue with, or at least scratch my head about a little bit, is how much these companies are going to be spending on their AI ambitions. Even if you think back to Meta's earnings call, they had said, we're going to give some more kind of guidance in the future about what that total dollar figure of expenditures towards AI will actually look like. Have we gotten any more clear indication from whether it's Meta or whether it's Alphabet how much these dollar figures could rack up to be in their spending versus how immediately accretive it will be to their business and profitable at the end of the day?
Yeah, you hit on a great question. It's the center of a lot of debates we have with investors. And we haven't gotten great specifics, but directionally, we have started to see signs that they are going to spend here. Google, for example, on their 4Q call, said that CapEx would be flat for the year. Well, 3 months later, they're saying it's up. And not only is it up, but there's going to be a big mix shift towards technical infrastructure and a reduction in CapEx on buildings and real estate. So the real CapEx on the server side is going up quite a bit. Last quarter, Meta said they didn't change their CapEx guidance, but they seem to open the door to spending more for generative AI. They said their existing plan does not incorporate a lot there, but I think in conversations since then, they've indicated that if they do see a lot of traction with product there, they might have to spend more. So coming out of last quarter, we took up our CapEx estimates for Meta from the low end of the range this year to the high end of the guidance range, and we took it up several billion above consensus for next year. So we do think they're going to spend there. And then again, with Amazon, we haven't gotten much in the way of specifics other than the company has been very clear that while they are reducing their CapEx on the physical infrastructure side for e-commerce, they continue to lean into investment in AWS, in part to get ahead of demand they expect to see from generative AI. So I think across the board, particularly as we get into 2024, we expect CapEx to continue to rise across the mega cap tech landscape.
Well, and I'm curious, Lloyd, is it increase or is it redeployment, both on the parts of these three companies, but also on the parts of their clients, right? Because, big tech companies have AI budgets already, presumably, right? Is it just that they're redeploying that into generative AI, say, from the machine learning they were already doing, or what does that look like?
Yeah, it's a great question. And what we've found is that it depends on the company, but I think to a large extent, they are able to invest less in CPU-based infrastructure. So some of it is just shifting from CPU to GPU-based infrastructure. Now, GPU-based infrastructure is expensive, and I think there will be a net increase, but some of it will be moving things around. And then another thing we've heard talking to customers of the cloud platforms like AWS, GCP, Microsoft Azure, is that to some extent, the desire to do more generative AI will hasten their overall move of workloads into the cloud platforms. So it may help the underlying business in terms of storage and compute as well. But bottom line is, it will, we think, drive a net increase, even if some of it's coming from existing CPU-based CapEx.
Lloyd, you mentioned something really interesting earlier, and I got to be quick here, but it is in how, where, and when some of the ads will appear when generative AI is really kind of engaged with from the user perspective, and any type of advertiser that's kind of putting creative out there and trying to make sure that their message gets in front of that consumer, how it is going to be much different than what we've known for the better part of 2 decades now. So all that considered, does it change the value of that ad placement so materially to the point where we're going to be looking at a different type of margin profile that the search engines are going to be able to generate?
Yeah, I don't think it's going to ultimately be all that different. Okay. I think our concern is that Google's optimized their search page for a combination of kind of user experience and monetization, and they've perfected this over a multi-decade period. And this is just a big change. They're prioritizing user experience initially, as they should, and so there may be some short-term disruption. We already see signs that it may look very similar over time with how the search page looked before, but we just think it's prudent to assume that there may be some near-term disruption while they effectively experiment with this.
All right, Lloyd, we appreciate the time here breaking down how you're looking at some of the biggest tech names across the street. Lloyd Walmsley, who is the UBS Equity Research Analyst. Thanks so much for the time.
Thank you for having me.
Absolutely.
Well, we've got breaking economic data coming down the pike in just moments. New home sales, where we have seen strength, as well as consumer confidence. And let's start with consumer confidence, coming in stronger than estimated, 109.7. This is for the month of June, and it's from the Conference Board. 104 is what economists had been estimating, and 102.3 was the reading the prior month. The present situation ticking up to 155.3, expectations going to 79.3. So both of those measures improving here, which is interesting. New home sales, meantime, rising 12.2% month over month in May to an annual pace of 763,000. So indeed seeing the strength there. One of the themes that we have talked about in the housing market is that with the tight supply in existing homes, because homeowners don't want to put their homes up for sale and buy another home in a high mortgage market, that we are seeing construction really pick up. And so that inventory increase, and that might be fueling some of this new home sales action. But we're going to talk much more about all of this in just a few moments, about the mortgage market, also about some new pricing data that we got in housing. So that's coming up in just a few.
That's right. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
The AI stock bubble will burst when it bursts, and you will not be able to tell when the stock bubble bursts. I'll say this, if you see AI stocks like C3 AI and Salesforce going down for, 10 straight days, the bubble has probably burst.
Welcome back. It's just after 10 a.m. in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman, and we are 30 minutes into today's trading activity. Let's take a look at some of the top movers that we've got for you this morning. First and foremost, Walgreens, ticker symbol WBA. The shares sinking this morning after taking a hit from a slowdown in consumer spending in the third quarter. The retailer slashed its full-year earnings guidance as a result, with its CEO citing significantly lower demand for its COVID-related offerings.
We're also watching Meta shares today after the tech giant got a price target boost from Citi, now sitting at $360. That's the highest on Wall Street. The bank citing a strong rebound in advertising, with Meta's Reels, they say, in a strong position to capitalize. The shares up almost 2.5%.
And Eli Lilly, also on the move this morning after new results from its obesity drug showed patients lost 24% of their weight over the course of nearly a year. These are the highest results seen as several healthcare companies, including Pfizer and Novo Nordisk, compete in the space.
A lot of housing data out this morning. Let's talk about S&P Case-Shiller. That's pricing data. It's for April, so a little bit older there, but it did show the third straight month of increases for that data, even though it did have a year-over-year increase. For more on the state of housing and also the new home sales data that we just got, let's bring in Heidi Padalano, National Mortgage News Editor-in-Chief. And Heidi, just looking at the new home sales data we just got, up 12.2% for May to an annual pace of 763,000. The dynamics here, given what's happening with mortgages, are really interesting, sort of between the new home sales market and the existing home sales market. What stands out to you?
Right. Well, it's very interesting because I think a lot of people in the home finance space have kind of accepted that, they're about 2/3 of borrowers have locked in rates that are 4% or below, right? So those people who are already in homes are really not going to have an incentive to list anytime soon, because then they'll be shopping for a home at a much higher rate. And with the Fed signaling that they will, most people are guessing that they will continue to raise rates in the near future, there's kind of this acceptance that they will kind of creep up continually for the rest of the year. So with those existing homes just kind of staying locked with those homeowners, we're really turning to new construction and new homes, new inventory. Home builders are feeling great right now because that's where the interest is, the new inventory that's coming onto the market. And certainly we saw mortgage applications for new homes up 16% from last year and 8% from April to May. So there's really a surge in new inventory. People are very optimistic about what's coming onto the market.
And so for the new home producers that we've been tracking as well in the equity markets, I mean, is this kind of a broad-based production, if you will, recovery versus some of what they had been facing in materials issues, prices even of lumber, as we've started to see that moderate a little bit more? Right.
What I've heard is that it's a lot of catching up from backlogs of COVID with those constraints that they experienced then. So there is a bit of a little bit extra coming on because they're just really catching up to where they were so far behind before. Mm-hmm. I think there's also a really interesting push for manufactured housing at this point. Certainly, there was a report from Zillow last week that said, we need another 4.3 million homes to meet the demand. And that's including people who are really priced out of this market but would want to buy a home that was more affordable. And a lot of people at the governmental level and certainly in the private sector are saying manufactured homes could be the solution for that.
What does the graph usually look like between mortgage rates and home prices, right? Does there tend to be an inverse relationship, as rates go up, do prices come down? And is that happening to the same degree this time around?
Yes, I think there is a bit that does happen because, the sellers who really want to sell are motivated to make it a little bit more attractive to those borrowers who are reticent to sign up for a 7% interest rate. A lot of people in the mortgage industry say marry the house and date the rate, and they try to encourage the home buyers to, just get in now and then refinance in 2 years. And we've heard predictions from the Mortgage Bankers Association that rates could get down to 4.9% by the end of 2024. So that could be, that's kind of good. That might entice some people.
It also feels like we have seen an explosion in the mortgage brokerage industry, or at least consolidation, right? Like we cover some of the publicly traded companies that are the mortgage brokers. Has that been better for home buyers? How has that affected the experience? Is it possible, even in this environment, to really find competitive rates?
Yes, I mean, I think cyclically, when rates go up like this, many LOs tend to then become brokers. They move over
LOs, loan officers.
Sorry, pardon me. Yes, they become brokers. So they go out on their own and they're trying to source loans to really get homeowners or potential borrowers the best deal possible. So it's good for them because they're really working as an advocate for the borrower to get the best deal possible. And certainly those offering wholesale loans are really trying to stay competitive and keep their volumes up. And so they're incentivized to try to make a good deal.
I've got several homes in tabs on my laptop, mostly shipping container homes at this point, and a couple tree houses. But for millennials, as we're thinking about the type of homes that we can realistically get into, as we've tried to move through a financial crisis, some of us, as we were just going into college, and then coming on the other side, trying to get jobs, and then now weathering through, of course, the COVID pandemic, all of these different things, as at the same time we're looking to purchase a home, rates are rising once again. So at that point, has it shifted the mentality around the type of home that millennials are purchasing?
Absolutely. Freddie Mac had a study from 2022 that said about 60% of respondents were open to non-traditional single-family homes that are, manufactured homes. So people are really starting to understand that the manufactured homes of today are quite different from what might be in your mind of those that, made 10, 20, 30 years ago. They're better construction, they're customizable, they're built to last, sustainable materials, and I think the younger generations are a lot more open to that. Arisent, the parent company of National Mortgage News, recently conducted a survey of mortgage lenders, and they're really focused on trying to reach the younger generation. By 2034, they will be the largest demographic in the country, and in the next 10 years, they'll make up a third of all consumer debt will be taken up by Gen Z. And so we found in our study that they're really trying to reach them on social media channels, particularly banks and credit unions are trying to make that effort to educate them on things such as manufactured housing, on, did you know that you could actually, this is within your reach, you could actually afford this. It's all about just getting to those borrowers where they are, which is largely on social media.
It's funny, our executive editor, Brian Sazzi, earlier today posted a historic video on Twitter of a Sears house. Now, for those of you who are not familiar, Sears used to sell manufactured housing, but they would ship it to you in components. Yes. And then it would be assembled. Sears, the old department store retailer, for those of you too young to remember because it's not really around anymore. I once lived in a modified Sears house.
Really?
Fun fact about me, that had been split up into different rooms because the family who owned it before us had a lot of kids. Wow. It was perfectly nice house. Maybe Sears needs to get back into the business, Heidi. I don't know.
Hey.
Never say never. All right, Heidi Petalano. Sorry for my little tangent. National Mortgage News Editor-in-Chief. Thank you. Appreciate it.
Thank you so much.
Next up, we're going to talk all things Fed. You're watching Yahoo Finance. We might agree on this one also, Saz. NVIDIA is the clear leader here at the halfway point. It's up the most in the S&P 500 year to date, something like 180%. It's all about AI, but we don't know how the second half of the year is going to go.
Yeah, essentially, Julie, you're almost like taking a peek or a preview of Yahoo Finance potential Company of the Year award winner. And I might have to put Meta for early consideration. The stock is up 140% year to date. Advertising has started to come back a little bit. This is a company that has canned over 20,000 employees. Reels is starting to gain some traction. Maybe a potential stock story of the year. And Meta, I can't believe I'm saying it though.
And if Zuck wins, seals it.
If he chokes out Elon Musk, it's all in. Yahoo Finance Company of the Year award going to Meta.
Concerns over the Federal Reserve's rate hikes tipping the U.S. into recession have reemerged. Last week, Fed Chair Jay Powell signaled more interest rate hikes are likely to come this year. The market expecting another quarter-point move at the Fed's July meeting. Can the Fed's playbook help the U.S. economy defy odds and avoid a recession? Let's bring in Vincent Reinhart, Dreyfus and Mellon chief economist, to discuss. What are the odds, I guess, at this point, Vince? Kind of where do we stand, and what do you think the Fed is going to do at its next two meetings?
It's tough to worry about recession on the morning in which housing came in so strong. If it's a recession, it's going to be a different kind of one, and I think most likely the economy will slow pretty markedly in the second half of this year into next year. That doesn't matter for what the Fed's going to do at its next meeting in July. They're going to raise rates a quarter point because they pretty much told us they'll do that. They have projected that they'll increase in total a half point by the end of the year. But that second step is a little more doubtful, exactly because the concerns about the economy are going to start mounting.
So does that just mean a cut is off the table anytime soon, even for those who have kind of bucked the trend out there and economists that have said, we could potentially see one if things get dire enough or if they get worse enough to the point where the Fed has to acknowledge it?
You can talk about cut, but you also have to add in the fullness of time. They're pretty clear that nobody on the policy setting committee expects rates to be cut in 2023. The recession dynamics we're talking about happen quickly, but it's not this weekend. It's going to take a little bit to evolve, and it's going to take a while for the Fed to recognize it. And meanwhile, inflation is stubborn. It will be above the Fed's goal still, and they're going to have some hard policy choices. So in fact, what the FOMC has accomplished in the last meeting cycle is mostly convince investors that the funds rate is going to a plateau in 2023, and it's going to stay at that plateau. No rate cuts this year. Whether that plateau is a quarter point higher from here or a half point higher from here is subject to more debate.
Has the Fed done a good job in communicating that message? I think about Christine Lagarde, the ECB president, who spoke today, pretty universally seen as a fairly hawkish message, a clear hawkish message. Does Jay Powell need to take some lessons from Lagarde, or do you think he's been clear enough?
So I think Chair Powell has a committee that he's got to corral into the policy decision. That's one problem. I kind of think he's a reluctant warrior. That he, among the members of the FOMC, are the one of the ones least inclined to tighten much more because he thinks there's credit constraint coming down the pike. Last meeting was a modest policy mistake wrapped in a communication error. The communication error is they didn't give a good rationale for pause. You saw it in the press conference. They said they're awaiting more information to make a better informed decision. That's why they didn't raise rates in June. But they also raised their forecast a half point for where the funds rate will be within 6 months. Explain to me how you could get enough information to revise your forecast up a half point, but it isn't enough information to make you want to change the current policy rate. That's where they didn't do a good job communicating.
Yeah, and Powell kind of downplayed the forecast, right? That I heard one commentator actually call it a horoscope. So I guess people suggesting people should take it with a grain of salt. It's ironic, Vincent, you say that the Fed chair didn't do a good job of communicating the rationale for a pause, if in fact you think he's really the one who wanted that pause, right? Or even would want the FOMC to be done. Why do you think he's not getting the message out better?
So the most time-honored technique for a chair to put off their committee is to say, hey, we'll know a lot more in 6 to 8 weeks. And that's exactly what Chair Powell did. I think when you listen to some of his answers and testimonies when he was up on the Capitol Hill delivering the semi-annual testimony, he's waiting to see credit constriction. We had bank runs in March. We were really worried that this was going to turn into a systemic problem. It didn't thus far, but those sorts of sudden withdrawals from banks, according to Powell, should be associated with a constriction on credit, 6 or 9 months later. We're coming into that window. He wants to see some evidence that maybe the quantity channel of policy constraint is kicking in a way that the price channel, what happened to the rate, has done so less.
The employment situation on part of the Fed's dual mandate, that's remained resilient and thus has led to a resilient consumer, even showing up in some of the consumer confidence data that came out this morning, saying in commentary, assessments of the present situation rose in June on sunnier views of both business and employment conditions here. And so if we continue to see an employment market or a labor economy where consumers would point to and say the opportunities are still plentiful, then how does that make the job of the Fed that much more difficult at the same time that they are still in their tightening process?
And add to that, part of what is facilitating consumers' optimistic view of the economy is that equity markets are doing well. Risk markets generally are doing well. Here's the irony for the Fed. The less they're believed about their longer run policy intentions, the more receptive markets are to the situation, the more aggressive pricing is, the more the Fed's got to tighten. They have to offset that strength coming from consumer enthusiasm, from a buoyant equity market, because what's their goal? Their goal is to slow the growth of demand so that production moves into better alignment with output. Employment gains of 339,000 workers a month just isn't consistent with that. And their problem is this is a really low productivity economic expansion. We're just not getting much output per hour. And so a lot of things are diverging. We're adding a lot of employment, but we're not adding as much output.
Vincent? Yeah, sorry, go ahead, finish your thought.
No, go ahead, I'm done.
Well, we have to have you back here soon. Vincent Reinhardt, who is the Dreyfus and Mellon chief economist. Vince, great to have some of the time with you this morning.
Okay, thank you.
All right. You're watching Yahoo Finance, folks. We'll be right back.
I mean, it's a totally unknown variable. Judging from the market reaction to the events over the weekend, we might not see much of a reaction at all, particularly in U.S. markets, which don't seem to care that much about geopolitical risk.
If anyone tells you they know how much the stock market will rally, if Putin loses control, loses the war, they're out of their minds. You cannot predict these things. But what I could say with confidence, if Putin does lose control and does lose the war, you might see a rally in commodity stocks because Ukraine will have to be rebuilt. So you want to start looking at gold plays, silver plays, you name it. But again, who the hell knows?
Retail investors are heading into the market in full force. Last week saw non-professional investors pour a record $1.5 billion into stocks. The majority of single stock inflow was into S&P darlings Tesla, Apple, and Nvidia. That's according to data compiled by JP Morgan. But did retail join the YOLO rally too late? In the past week, Nvidia shares, for example, have steadily declined, down almost 5%. With more on the state of retail traders, we're joined by JJ Kinahan, IG North America CEO. Hey, JJ, good to see you. Timing the market is hard, as we all know.
Yes.
But it is interesting to see this retail enthusiasm. What do you make of it, and do you think it's a sign that things are going to turn further?
Well, Julie, I look at our clients' behaviors, and what's really interesting to me is that this has been a year that's been very largely defined by actually retail traders buying more ETFs that are index related. What do I mean by that? SPDRs, QQQs, to a lesser extent IWM, representing S&P 500, Nasdaq, and Russell. And so what's been interesting over the last 3 weeks is we've definitely started to see more single stock play than we had seen for most of the year. And as you just said, Tesla has become the #1 darling of retail traders, and that's a change from the last couple of years. It was all about Apple and Microsoft. Right now, it's more about Tesla and Nvidia, with Apple being the third wheel. So what we saw out of our clients is the last 3 weeks, they have been very heavily been buying Tesla. But it was really interesting that about last Thursday, we saw a little bit of a change in their behavior. And the change we saw in their behavior was more clients who would buy Tesla doing so also with some put options as protection, or we saw them doing more short-term trading so that they weren't carrying this longer-term position in Tesla. I thought that was really interesting. Nvidia, on the drop, I think more people perhaps are attracted to it for a longer term, because those that were buying Nvidia were not doing so for shorter term trading. And Apple, when people buy it, they do tend to hold it for a longer term. It's a stock you actually see a lot of clients hold and then sell upside calls against, so that they can collect that premium if it doesn't go up enough, or they'll get it called away at a price that they're comfortable with. So I think that the behavior pattern has really been interesting over particularly the last 3 weeks, and particularly around the Tesla name, which had, as you just said, such an incredible move over the last few weeks.
But does that behavior pattern scream to you that the valuations are substantiated right now, as retail traders are evaluating some of the largest FOMO trades that you're laying out in front of us?
Yeah, Brad, it's always interesting in terms of the fact that we tend to find these favorites of retail over the last few years, when they have these downward pockets, have been able to recover. Not saying, of course, that they're going to recover. And I think that this is the first time we've seen a desire to go to some of the single names from. Well, let me explain what I mean by that. And the fact that, as I said, we've seen a lot of ETF-related trading and people adding to those positions. They have not been aggressive about adding to single-name positions. This is the first time we're starting to see some of that behavior over the last, as I said, about 3 weeks. So the Nvidia one is one that, as the stock has come off 5%, maybe you're seeing a little bit more of that type of behavior. But as I said, with Tesla, I'm seeing people being more selective on where they buy it, and Apple just tends to be a bit of a retail favorite. So I guess, breaking that question down to the three you just asked me about, Nvidia would be the one that I would actually worry the most about, perhaps being, overpriced, or whatever you want to say, or having a multiple that's too high based on this type of behavior.
There's a lot of discussion about that we need broadening of the rally. Are you seeing any signs of retail buying beyond some of these concentrated names?
Unfortunately, not enough, if you will, in order for us to continue the rally. The technology names, you could probably throw Microsoft in there and a couple of others that people are buying. But we're not seeing that buy, particularly across financials. And that's the area where I really think you need to see the buying in order for this to continue. Because financials not only help the S&P 500, as everybody watching your program I'm sure knows, but I think one of the overlooked things about buying financials is it being the #2 sector within Russell helps to lift that index also. We're seeing the outperformance of the Nasdaq this year. S&P 500 has obviously done pretty well over the last couple of weeks, but if we're going to say, okay, we really want to see a springboard into the end of the year, we're going to need the financials to perform. And the fact is, with the, you guys talk about the yield curve all day long on here, and with the 2-year still being above the 30-year, it's not giving the financials the sort of springboard they need to get higher. And because of that, you're seeing people nibble around the edges every time we have a rally where they start to buy some of the bigger banks, the Bank of America, JP Morgan, Citigroup, Goldman, but they're not really committing to that. And I think that that's been the biggest thing, that one of the reasons we can actually probably continue higher overall is I think in the market overall, and particularly with retail, we're not seeing people convinced to really commit to names in a big way. It's slower adding to their portfolios. Where you get into a lot of trouble is when people have the true FOMO, they have to be in. We're not seeing that behavior, and I actually think that's a positive for the market overall, is that people are dipping, they were dipping their toe in the water. Now maybe they're up to the top of their calf. We're not seeing them diving headlong in, and overall that tends to be a positive.
Yeah, question of whether it's some of the kind of East Coast not clear water, or some of the clearer waters of Europe or other parts of the world, because the international trade is one that retail investors have had to keep their eye on, given some of the projections for where consumer spending would reemerge, where economies would continue to scale up, and more largely, there is this question of whether or not retail investors are impressed by the international equation. Is there anything in terms of flows that you've seen there that points one way or the other?
Well, I think the ones to keep our eye on there are going to be those Chinese ADRs, particularly with the announcements yesterday out of China that they are putting more money in, some stimulus, and have committed to growth. And so, the Baba's, JD.com's got a little bit of a bump yesterday. We'll see if that can continue and we get some life out of the Chinese stocks, which have done okay, but haven't really rocketed anything spectacularly. I think as we look across the, that would be great to see the Chinese stocks performing well. And I think that'll give a bigger lift, of course, to the tech stocks. It'll be interesting to see what that would mean for retail overall, and if that could breathe some life into the retail market overall, or I should say into retail stocks overall. And then I think as we look across the rest of Europe, et cetera, you're still seeing those very high inflation rates. We saw, last week, the Bank of England decide to raise rates again. So it becomes a matter of now what happens with rates. The central banks still are the subject. Again, as I don't have to tell you guys, talking about this a lot throughout the day with a lot of folks, they are the primary focus of what everybody's doing right now. We've seen the probabilities. Many were expecting a rate cut by the end of the year. I think what we're seeing right now is that probability has been taken away pretty significantly. In fact, if we look out to the December timeframe in meeting, there's only a 5% probability as of right before the opening this morning that there would be a rate cut, yet there's a 67% probability that there would be a rate hike. We know going into the next meeting that it's almost a 77% probability of a rate hike going to the July meeting. So again, I think many of those folks who were expecting the rate cut to be a stimulus, that is sort of going away. So we're going to have to look elsewhere for stimuli. And what we're seeing right now in the VIX through July 4th is there doesn't seem to be a lot on the plate to, disrupt it. So seeing things like consumer confidence this morning, et cetera, can perhaps give us some positive stimulus going into the, the month of July.
We'll see. JJ, good to catch up with you as always.
Always
JJ
great to see you.
Canahan,
Thank
IG
you.
North America CEO. Thank you. We've got an update on the ongoing dispute between 2024 presidential hopeful Ron DeSantis and Disney. The Florida governor's attorneys filed a motion on Monday seeking the dismissal of Walt Disney Company's lawsuit against him. Here with more, Yahoo Finance's Alexandra Canal and Alexis Keenan. So, Alexis, let's start with you. What is the argument coming from DeSantis' lawyers?
So what the lawyers are saying, and this is the Attorney General of Florida coming in here on his behalf and on behalf of other Florida officials, and it relates to Disney's federal case filed months ago saying that the lawmakers in Florida, as well as DeSantis, kind of got together to pass these laws and sign into law a string of state laws, actually, that take away and strip from Disney its right to self-govern a roughly 25,000-acre parcel around Orlando on which its Walt Disney World and other related properties sit. Now, this motion specifically is asking the court to toss out this federal case, which is filed in federal district court in Florida in Tallahassee. They say that this case has no place in the federal district court, in federal courts at all. They say that there is immunity for DeSantis and one of the other officials named in this lawsuit. As far as the federal court's jurisdiction, they're arguing, DeSantis here, saying that the court has no jurisdiction over them, that the 11th Amendment in the Constitution protects them from this type of suit coming after, in a federal capacity, coming after a state and state officials. On the other hand, the immunity angle here, DeSantis and the others are arguing that they should be immune because of legislative immunity. Kind of an interesting argument there. DeSantis not necessarily a legislator, but saying that he's acting, when he signed this law into law, he was acting in a legislative capacity. Still separately, though, the new board that is now controlling this swath of land on which Disney World sits, they too have a suit against the special district. They sued Disney, saying that the company should not be able to go forward and continue to govern this land. So kind of dueling lawsuits here.
And Allie, what's the impact of this on Disney?
I think the impact is going to be different depending on the perspective that you look at it. From a consumer perspective, the parks are fully operational. You can go to Disney. I don't think you would realize anything was going on. But from a company perspective, the concern is that if Disney wanted to create more parks, if they wanted to do some other type of infrastructure building, they would need the approval of the oversight committee, whereas before they were able to do these changes and whatever they wanted pretty seamlessly. So that is a concern from Disney's perspective. Now, from the employee perspective, I think they're happy that Bob Iger has consistently spoken out against DeSantis. He's defended the company's actions. He actually said, all right, does the state of Florida not want us to invest in the state of Florida? Disney has plans to invest $17 billion over the next 10 years, creating 13,000 jobs. And you could argue that that was the demise of Bob Chapek. That's what started this all. He initially chose not to speak out about this issue, and that created this ripple effect that eventually led to Bob Iger returning. From an investor perspective, doesn't really seem to matter, right? The stock is flat, positive territory right now. We just got 2 buy ratings, reiterating their buy ratings from Bank of America and Guggenheim this morning. So I think unless we see any fundamental impact on the bottom line of Disney, it's nothing that's going to affect the stock price. But I do think these are lawsuits that are going to take, it's going to take a lot of time before we get a conclusion to all of this.
Right. It feels more like sort of culture wars than it.
Yeah, before we get a conclusion to all of this.
Right. It feels more like sort of culture wars than it does something that's going to have an effect on the company. But I guess we'll see. Thanks, guys, for keeping us posted on this lawsuit. We'll see how it turns out eventually. Allie and Alexis, you're watching Yahoo Finance. What's the song of the summer,
I'm not
Saz?
remotely plugged into anything
No,
cool.
you didn't hear anything cool when you were in France?
I think it might be Taylor Swift. Maybe something from Taylor Swift. I don't know.
Are those bops? I don't know.
I
don't know either. I'm not a Taylor Swift fan. Apparently, the new Kylie Minogue single is big. Padam Padam.
You know what's hot for me right now? Old school songs by Billy Ocean. I'm a big old Billy Ocean fan.
recovering slightly after taking a hit on Monday, even after a strong earnings report. Yesterday on the Yahoo Finance 3 p.m. show, host Shauna Smith and Akiko Fujita spoke with Carnival CEO Josh Weinstein. Take a listen.
So a very strong quarter, revenue doubling from a year ago, customer deposits hitting a record. You raised your outlook, yet the stock sinking today. And I think a lot of investors out there are questioning how much more room there is to run. What's your message to them?
Oh, my message is we've just scratched the surface. So first, thank you for having me. I can tell you that we ended our second quarter, as you said, in a pretty strong way. We set records. I mean, the one word I could use to describe it is record. It was record yields, record revenue for the second quarter, record customer deposit levels. And here's the future stat for you. So typically in our industry, we have a wave period of bookings, and the wave period, which is our peak booking period, is the first quarter of the year. What happened with us? Well, what happened with us is we started our wave period in the fourth quarter with a Black Friday event that just literally started with a bang. Our first quarter, the traditional wave period, did set a record. And that was great until the second quarter, where we beat the first quarter. And that is truly unprecedented. And in the first 3 weeks of June of our third quarter, it hasn't slowed down. And so the fact is that demand is real. And I would actually say at this point, I don't look at it for our business, for our brands of world-class brands, a portfolio of world-class brands, as real pent-up demand because they hadn't been able to cruise at this point. This is just demand. This is just people wanting experiences, looking for great value, looking for great brands, and they're finding us.
Josh, let's talk about per diems, up 7.5% in the quarter. You're now forecasting growth of 5.5% to 6.5% above the 2019 levels for this year. How much higher can that go?
So our expectation is, we set some targets for ourselves, 3-year targets that'll get us out to 2026. And we expect a good amount of run up in yield. Now, clearly, we've still got some occupancy to make up when you think about our annualized occupancy levels. And so we'd expect to get back to full historical levels next year, which is going to be a nice jump in revenue. But on the per diem side, on top of that, we expect low to mid single digit per diem increases over the next several years. And we think we can achieve that.
Josh, there's lots of focus on getting back to profitability. Your balance sheet, yes, does look a lot better to where you were when you compare to those peak debt levels here. But what's your largest obstacle, your biggest challenge when you're trying to get back, when you're trying to get to profitability?
From our profitability for the third quarter, we'll be profitable in the third quarter, and that's a turning point for us, just like hitting positive yields was a turning point in this second quarter. And we're looking forward to 2024 and beyond, where profitability is not going to be the question mark hanging over the industry. We are showing incredible progress every single quarter. We are just making leaps and bounds. I think, for us, it's a long-term game, and we want to see that progress every single quarter, and that's what we're delivering, and that's what we expect to keep delivering every quarter. And that's the mandate internally, and that's what we're focused on.
Josh, whenever we talk about cruises, we tend to bring up the demographics, right? We know who the loyal customers are. Some would call them boomers, but you've obviously got a number of brands out there that are trying to bring a newer, younger demographic into the fold. How do you do that? And what specifically, or how specifically are you targeting them?
So because we have a portfolio, we've got brands that are really catering to different segments, different demographics. We've got Carnival Cruise Line. It is America's cruise line. It caters to younger people, to folks in their 20s who are single looking to go for a quick holiday with their friends, to families with young kids looking for a cost-effective way to have an amazing family experience. And so we've got brands that can really do that. Now, our focus, we have truly, despite the strength of our brands, despite being number 1 or 2 in every single major cruise market in the world, we have not done a good enough job of getting even higher awareness and consideration of our brands, because we simply haven't been spending nearly enough in advertising, which has been a change of approach since I joined about 9 months ago in this role. And you can see that paying off. And I'll give you a great example. In the first quarter of this year to the second quarter of this year, the number of repeat cruisers that our brands carried stayed the same. It was great. It's a solid level, and it stayed the same. We went up in total number of passengers carried by about 13%. that entire growth in passengers was from new to brand and new to cruise. So our message is getting out there, and it's really starting to resonate with, as you said, a broad audience, indeed.
Josh, demand certainly has been strong, but what about risk of recession? If we do see one, what's the impact?
You know, we're in a very good position when it comes to thinking about what's the impact of a recession on our business. You know, at any one time, we're about 50% booked for the entire year. And now we're getting better and better at getting people to spend their onboard experiences beforehand too. So even that, we're getting more visibility and getting it quicker. On top of that, you know, I hate to say this, but you know, I do say it. We are an outrageous value to land, anywhere from 25 to 50% less expensive to come on one of our ships than a comparable vacation, whether it's a theme park, a city break, whatever it might be. That is outrageous. Now, the good news for us is in a time of a recession, that value gap shines through. And as people are thinking about how do I spend my hard-earned money to make my vacation work, because that's one of the last things that they're going to give up. And that's where the value proposition really shines. You know, we've got a strategy with our leading brands around the world. We've got about 75% of our capacity of our ships. They are positioned where our source markets are, where our Americans are for our North American brands, Germany, the United Kingdom, et cetera. By being able to do that, we take a lot of cost out of the equation when people are thinking about their holiday with us versus alternatives.
Mm-hmm. Well, your momentum certainly being reflected in the numbers. Josh Weinstein, Carnival CEO, President, and Chief Climate Officer. Good to talk to you today.
I actually think we are in agreement on the Musk-Zuck cage match. Both of us are taking Zuck, right?
I'm taking Zuck, but how does Zuck seal the deal? I think he chokes Elon out on the mat. I think he chokes it out. Why? Because he knows Taekwondo, and I think he's ready to put overweight Elon Musk to bed.
I think he's a jiu-jitsu guy.
Sleepy time for Musk.
But that does also involve grappling, and Musk has the weight advantage, but
Can you imagine me putting in a chokehold by Mark Zuckerberg? How terrifying.
EV sales are steadily climbing uphill as more drivers make the switch. And Ford is one auto giant following the trend as it invests billions of dollars in the shift. But that could come at a cost. The company is now reportedly planning to cut hundreds of salaried workers in the U.S. this week as it aims to lower costs, according to Bloomberg. Shares here today, they're moving higher by about 1.4%. But Ford and the larger commitment that they've put forward really requires this reallocation of both capital as well as human resources right now.
Yeah, and the reports are also talking about that a lot of these cuts are made in engineering for combustion engines, so that makes sense, right? If you're putting a lot of your energy. On the flip side, there is a conflicting signal in terms of the demand for EV, and that's coming to us from Volkswagen. There was a report by a German newspaper that the company is going to reduce production of one of its electric vehicles, the ID.4 compact SUV, also the ID.7 sedan, at one of its factories in Germany over the next couple of weeks, and that's because of weak sales. The share is not taking that big of a hit here, but it is kind of interesting that at least in one sector there's not seeing that strengthening demand.
And there's a considerable focus around where among some of the pro customers or commercial customers they would start to see a switch kind of across the board in EV sales right now. And if you think of the companies that have long had some of the relationships into that, it is Ford, it is GM. And so if you see commercial vans and fleets start to, and these larger purchase orders really start to add up as those transitions are made across delivery, logistics companies and suppliers, that's where a Ford could see some of their market share start to catch up. But right now it's been about the just everyday consumer who's trying to get this into their garage or into their driveway.
I know someone who just got an electric Volvo, and they love it. They love it.
Interesting.
I don't know. Coming up, let's take a final look at the markets right now. We're not coming up. Right now, let's take a final look at the markets. We've got all three major averages strengthening here out of the gate and from the open. The Nasdaq right now leading the charge. It's up about 0.5%. We're seeing a comeback, Brad, in some of those big cap tech stocks.
Yesterday we took an L. Today we come back, bounce back.
Yeah. All right. Have a great day, everybody. Rochelle's up next.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. Stocks are on pace to close out the second quarter higher, and that's despite a choppy start to the week. But not all analysts are riding the bull wave. Goldman Sachs saying any upside likely to be constrained by high valuations and rates. We'll round up the top commentary coming up. And AI has, of course, been the talk of the town in 2023 and created quite the tailwind for the likes of Nvidia and Microsoft. But will it hold its ground in the second half of the year? We discuss how artificial intelligence has dominated big tech and beyond, and what's still yet to come. And Eli Lilly ups the ante in the battle to develop the most effective weight loss drug, squaring up against Pfizer and Novo Nordisk. But who comes out on top? We've got the latest for you coming up this hour. But first, let's see how the markets are faring just an hour and a half into the trading day. Looking at some gains here across the board, we see the Dow here up about 130 points or 0.4%. S&P 500, they're also up about 0.5%. Tech-heavy Nasdaq there up 0.6%. A lot of economic news to digest this week, and so far, markets seeming to like what they've heard so far, especially on that housing data. Let's also check in on the Treasury market as well. We know that yesterday we saw something of a flight to safety. Seeing a different picture here today. We see the 5-year up about 1.89%, the 10-year up 1.2%, and the 30-year up just over 0.5%. But we've been inundated with analyst commentary since the Federal Reserve's hawkish pause. Some, like BCA Research, see the market rallying and the S&P hitting 4,500 by year end. Meanwhile, Goldman Sachs says stock returns will be, quote, fat and flat thanks to rising rates. So where are we really headed, and what does it mean for your portfolio? Well, thankfully, Yahoo Finance's Jared Blicker is here to break down some of that info. Hey, Jared.
Hey there, fat and flat. I like that line by Goldman Sachs. They're thinking higher for longer with respect to the Federal Reserve. And so what does that mean? It means that stocks are valued too high right now. They can't justify jumping in long now. What do they need? They need to see either rate cuts or long-term earnings increase in the forecast thereof. However, once you start pricing in rate cuts, guess what? That means recession, because why would the Fed cut rates unless they're worried about recession? And so that's the circle we're operating in right now. As you said, Rochelle, all indices in the green right there. I just want to focus on the sector action. It's been pretty instructive, not only today, but over the last month. Today, we got communication services and discretionary materials all up about 1%. Over the last month, I've been talking about the rotation that we've seen into some other tech, into some other sectors besides tech, besides the mega caps, and that's indeed what we've seen. Consumer discretionary, that's XLY, that's up 8.5%, followed by industrials, materials, and real estate. And just getting back for a second to some of these Wall Street notes. Also, Morgan Stanley out. They're expecting a hike in July. Now, that is not their baseline. That was not their base forecast a month ago. They thought it was going to be, we're over right now. That was as of the last FOMC meeting. However, they're saying that the Fed's hawkish tone, especially with Jerome Powell in front of the Senate and Congress last week, that kind of upped the ante a little bit on the hawkish stuff. And they're expecting, outside of very, very dovish reports from the payrolls that we're going to get and also CPI, outside of that, they think that the Fed hikes. So if we get a payroll below 100,000, or if we get a CPI print that's on a monthly basis above 0.2%, then they think that the Fed will have the reasons to pause. But just getting back to the earlier discussion of what happens when the Fed pauses, I just want to go back to the global financial crisis really quickly, because there's a very instructive example here. And in the meantime, I'm just going to pull up the VIX because I've been curious about that lately. But in 2004, the Fed had left rates at 1%, the very low for the time, and they started raising them. That was Ben Bernanke. He raised them into 2005, into 2006. In 2006, he paused for 12 months. Guess what? Stocks were making record highs that entire time. You contrast that with this cycle. We were in a bear market before the Fed even started hiking. So that's how quickly things are going right now. And it wasn't until the Fed actually cut rates in October of 2007 or thereabouts that we actually saw stock market finally decline. And that was the beginning of a huge bear market. Why? Because back to my original point, once you start pricing in rate cuts, that is an admission that you're going to get recession. So this whole thing is kind of, we're in a circular feedback loop right now. And some of it's defying expectations, defying reality, but eventually all these things come back to earth and valuations normalize and there's a return to the mean.
We'll certainly be tracking all of that. Thank you for getting us up to speed there, our Jared Blickery. All right, taking a look at new home sales in May, they defied concerns over a slowdown in the housing market, rising 12.2% compared to the prior month and up 20% from 2022, the fastest pace in over a year, boosted by limited inventory in the existing homes market. Will we continue to see this level of activity, though? Joining us now is Brad Dillman, Cortland Chief Economist. So, Brad, I want to get your big takeaways from these numbers, the month over month and the yearly view, to really give us a sense of where we are right now in terms of the housing market.
Yeah, so we had a substantial slowdown in new home sales, and now they've been rallying for several months here. Now we've seen a really big jump that kind of corresponds with some of the activity that we've seen in housing starts in general. The last housing starts print was very, very strong, to the point that many people think it may even be revised down. But it was strong in particular, not only because multifamily new starts were still strong, that's to say structures with 5 units or more, but because single family starts had really jumped. And again, we're seeing this in the new home sales figures as well. We're also seeing a return of some strength, or at least a very clear bottoming in at least the month-to-month pricing in the housing market, as represented by the Case-Shiller index as well. So it appeared to me that after about a year and a half, or really a year of some kind of slowdown in general in housing activity and disinflation in home prices, that we're now seeing a floor and then a potential rally.
And I know a lot of people have been waiting for the single-family home market to catch up with the multi-family market there. But talk about the supply of homes, because we did see the supply of homes available fell 0.9%, down 2.9% from last year. So what are we seeing here? At what point are we going to see this level out more?
Yeah, we're certainly seeing, homes listed for sale, right, have come down. But at the same time, we've got a lot of housing under construction. The new housing starts data would tell us that we now have, it's increasing again, close to 1.7 million housing units under construction. That's enough to rebuild every house, every home in Connecticut, and then half of Wyoming. There's a lot of housing under construction today. So we don't really need to look at the existing home sales, the existing houses that are being listed. We can really just see that there's a lot of new product in pipeline, and we're already seeing this start to clear in the increased new home sales.
And as we're in this pausing phase for the Federal Reserve here, then what is that going to do in terms of interest rates and people thinking, is now still a good time to buy? Should I wait and perhaps then refinance if I do buy now?
Yeah, I think that's a question a lot of consumers are asking themselves. It really depends on what's going to happen at the long end of the curve. Our own analysis right now would say that because the Federal Reserve is still engaged in QT, that's to say that it's shrinking its balance sheet, and that some of that shrinkage is coming from the mortgage-backed security space. Not only is the 10-year artificially high, arguably, but even the mortgage spread is pretty wide. So right now, I think people could look to at least the potential benefit that at some point these long-term interest rates might come in a little bit so that they might refinance. But certainly it's a challenge for anybody trying to buy a home today if they have to be using leverage.
And do you think we're at the end of the hiking stage for the Fed?
Yeah, we do. We think, again, the market indicates there could be a possibility of another hike here or there. But I think it's quite clear that if anything, they're more likely to end up cutting over the next year than continuing a bold hiking pattern. My own view would be that continued disinflation just in the CPI index, that's again to say that inflation itself is cooling, could give room for the Fed to create a policy rate that corresponds with a lower inflation rate without us necessarily going into a recession. That's another way of saying we could see rate cuts without us going into a recession.
That's certainly an option. We know that the Fed did leave those options pretty open, being a data-dependent Fed, especially at the moment. A big thank you there to Brad Dillman, Cortland Chief Economist. Thank you for your time this morning.
Thank you, Rochelle.
You're welcome. All right, I'm watching shares of CVS, the pharmacy giant, dipping today, down almost 2%, falling after its competitor Walgreens slashed its full-year outlook on decreased COVID demand. Now, CVS didn't report as a large part of a hit to its profits from fewer COVID tests and vaccines when it released earnings last month, but it did lower its guidance as well due to increased costs after acquiring Signify Health and Oak Street Health as well. Like other retailers, CVS has been hit hard this year as inflation causes consumers to pull back. The stock is down over 26% year to date. All right, we have plenty more ahead. You're watching Yahoo Finance.
I mean, something always causes a summer of chaos, it feels like, right? There's always like a thing in the summer that makes markets kind of go a little bit wacky. The Fed is as good a guess as any.
The Fed is definitely right on the cusp of causing a summer of chaos because That's what they do when they're trying to solve complicated problems. So what does a summer of chaos exactly mean? Well, we might be about to find out. It might mean a sell-off in hot AI stocks, might mean a sell-off in Google. Whatever it is, you can blame the Fed.
The GOP presidential race is heating up, with heavy-hitting topics already making headlines. Florida Governor Ron DeSantis spoke about his proposed immigration plan during a speech on the campaign trail in Eagle Pass, Texas. Now, Eagle Pass has become a hot spot of activity for illegal border crossing throughout Biden's presidency due to its proximity to Mexico. Let's bring in Yahoo Finance's Rick Newman to break this down for us. Hey, Rick.
Hey, Rochelle. Ron DeSantis, the Florida governor, he was in this border town in Texas. He unveiled what he called his immigration plan, and it's basically Trump's immigration plan. So just to remind people what that might entail, he wants to go back to building Trump's border wall, finish the job. He says he would end birthright citizenship, which, by the way, would require changing the Constitution. He would use force, meaning shooting people if they are carrying drugs across the border. Of course, you have to verify they're carrying drugs before you shoot them, I guess. And he even says he would use the U.S. military to go into Mexico to battle drug cartels there. Of course, I think the Mexican government might want to have a say about that. So this is what we've seen DeSantis doing in other ways, which is basically be Trumpy without the Trump chaos. So he wants to capitalize on the ground Trump gained with people for whom this is a really important issue and just say he'll do it more effectively.
So we're keeping an eye on that. I'm sure we'll be hearing more, of course, the closer we get to the election, and a lot more nuances in some of these proposals and policies. Rick Newman there for us. Thank you so much.
Bye.
Well, you're very welcome. The student debt forgiveness bill is still making the rounds in the Supreme Court, with educational debt at $1.6 trillion, according to the New York Fed. It's one of the biggest forms of consumer debt in the United States. Now, if the bill passes, the proposed program could cancel up to $20,000 in federal loans for those who are eligible. Let's bring in Wealthstream Advisors financial advisor Catherine George to talk more about how best to manage your wealth and, of course, your debt. So, Catherine, I do first want to start off with talking about student debt, sort of planning for it, regardless of what the Supreme Court does.
Yeah, it's a big change. It's been 3 years since we've all had these student loan payments. And even if this change that the Supreme Court is weighing in on this week, even if that goes through, many Americans still have student loans above and beyond that amount that's going to be forgiven. So how do we get back on track? There are plenty of apps to figure out what your expenses are so you can really start to know how we can cut back to start to plan for those student loan payments that are going to come back in. That's really the first step. Understanding where you're spending will help you guide kind of that next step. The second is if you can't cut your expenses, then you really should find a way to add some additional income on the side, side jobs or some entrepreneur options, just to get your income at a place where you can start to pay those loans. And really is starting now. Coming up with a plan so that you're ready when payments resume. That's going to be the most important thing, so that there's no chaos when that time really comes.
And as we mentioned, this does only apply to federal loans. If you have private student debt, you're still on the hook for it, regardless of what happens with the Supreme Court today. But I want to talk about this idea of, some people are wondering about supplementing their income with a side gig versus trying to get into investing. How should they approach it if perhaps they just don't have the bandwidth to take on another job?
So it's really about looking at what you can earn versus what you're paying in interest. And if we just focus on the debt, the first place to look when we have private, federal, or even credit card debt is to see what is the highest interest rate that I'm paying on this debt, and that is what you should target first. So really paying down the credit cards first, those interest rates are really high. And then the private is typically has higher interest rates than federal, and federal is last. Really, federal student loans also have a bit more leniency in terms of paying back that debt. So that really, really trumps there. But in terms of investments are long-term. So you don't want to be investing for the next year and knowing that you're going to have to make these payments. But if you have a big extra cushion that you can dedicate some of that on the side to long-term investments, we would hope that a stock portfolio would outperform the interest rate that we're seeing on those federal student loans. So that is a good option in terms of a way to get some extra income and making your money work for you. The second, I would say, is that right now cash is a really great option to earn something. High yield savings accounts offer really attractive rates right now just to sit in cash. There are also treasury bills, treasury money market funds, any other type of money market fund is a really great option to earn a little bit on cash and help you supplement those payments.
And for those of us who either have kids or are planning to have kids and you don't want your kids saddled with student debt, what could we be doing at this point to better prepare and sort of lay the groundwork so that our kids aren't saddled with $1 trillion worth of educational debt?
So it's a tough question because everyone's goals are very different. And when I speak with sometimes a client or a prospect, maybe they have their own debt, but they want to help support their kids. So what's a priority? And sometimes I have to tell my clients that you're the priority. You really need to focus on your debt and your savings before you can focus on your kids. But for those of us that have a little bit of extra leeway and maybe our cash flows, 529 plans are a really great place to start. In some states, you get a tax deduction, so there's some benefits there, but it all grows tax-free as long as you use it for education expenses. There are also some new rules that allow you to do some planning in the future, even if you don't use it for education expenses, but that could be a whole other topic. But 529s are a really great option.
And when you're trying to get to what your retirement number is, when you factor in what you're going to be paying, what's the best way to really calculate if you're actually doing as well as you should be doing in terms of your savings goals and managing your debt?
So there are all sorts of rules of thumbs out there, and I don't like any of them. It's really hard because everyone's personal situation is very different. What your risk profile is, what your stock to bond mix is, what types of expenses you have. Those of us that have healthcare expenses, those grow at a much higher rate than our just general living expenses. So really working with a professional who has the knowledge base as to how to grow your assets, how to think about inflation, and how you're going to supplement your lifestyle, even from a tax standpoint. Money in a retirement account is very different than money in a taxable account from taxes. So working with a professional that is going to look at your trajectory, see how much you need to spend, and see how much, how long your assets will last you. Really, as we live longer and longer, longevity is a really big concern. So making sure that you can have those liquid assets throughout your lifetime and working with a professional on that.
And what would you say is the biggest mistake people make when they're planning for retirement and perhaps, maybe they've left it too late, or some people are like, look, I want to start early. What do you think is the biggest mistake you tend to see people make?
So every client that I have wishes that they started earlier. Compounding, so that means starting very early and having your money grow. That is the most powerful tool. So starting really young, even if you're putting $20 a paycheck into some sort of investment or something like a Roth IRA, can be really powerful over that 30, 40-year period once you hit your retirement. But really, the best time to plan is 5 to 10 years before you retire. That allows for flexibility. If a professional comes to you and says you actually need to save a lot more than you're saving, at least you have the income and the knowledge and information to make those changes. It's people that hit retirement or are already in retirement that have to make really tough decisions like downsizing their home or reducing expenses that maybe they wish that they had started a bit earlier to plan for. So really thinking about having a plan before you hit that retirement age, or even a transition process of working less or working lighter.
Certainly makes sense. No one wants to have to make difficult financial decisions when they're already in panic mode. I do appreciate you joining us this morning. A big thank you to Wellstream Advisors financial advisor, Catherine George. Thank you so much. All right, stay with us. You're watching Yahoo Finance.
What's the song of the summer,
I'm not
Saz?
remotely plugged into anything cool.
No, you didn't hear anything cool when you were in France?
I think it might be Taylor Swift. Maybe something from Taylor Swift. I don't know.
Are those bops? I don't know.
I
don't know either. I'm not a Taylor Swift fan. Apparently, the new Kylie Minogue single is big. Padam Padam.
You know what's hot for me right now? Old school songs by Billy Ocean. I'm a big old Billy Ocean fan.
AI has definitely become the word of 2023, with many finding the new craze both exciting and frightening. Now, students are writing essays with it, and businesses are building out its core infrastructure. It seems, regardless of some big concerns, the new technology is here to stay. Yahoo Finance's Dan Howley joins us to discuss why AI took over the world, especially in this first half of the year.
That's right, Rochelle. I think the big kind of catalyst for this, and obviously everybody would point to this, was the release of OpenAI's ChatGPT in November 2022. That kind of set off a cascade of events ranging from the general public becoming aware of generative AI, really, I think, for the first time for a lot of people, to companies scrambling to get their own generative AI products out. Now, that's not to say that generative AI was invented by OpenAI. The transformer technology behind this was actually invented by Alphabet, which owns Google. They fell behind, though, when it comes to the public perception of AI. And so, as they saw ChatGPT moving forward and OpenAI moving forward with that technology, they were in the background working on their own tools. So we had ChatGPT released in November 2022. In February, we saw Microsoft announce its new Bing and Edge browser. Bing is obviously its search engine as well as chatbot. That was preceded a day by Google launching its own Bard chatbot. It didn't actually launch it. It just kind of said, hey, we're working on it, and we'll talk about releasing it later. They just kind of wanted to kind of, throw some water on Microsoft there. And then we continue to see this steady cadence of companies releasing or announcing or discussing the ways that they're working with generative AI, whether that was Meta or Amazon talking about getting into the space, adding it to different features. Microsoft continued and Alphabet continued to talk about adding it to their different offerings, whether that's the consumer side or enterprise side. And obviously the chip companies, as a result, started to jump on that as well. So as of yesterday, we had NVIDIA up 176% year to date. And then we also have other AI companies, the C3 AI, it's an AI enterprise company, that's up 190% year to date. So obviously this is a kind of AI boom. We have companies like, as I said, Microsoft, they're up 37% year to date. They're kind of, angling to take over the search space and also just kind of be the big AI player. And then we have Google up 34% year to date. These numbers are all as of yesterday on the news of its kind of plays in AI. And, outside of NVIDIA on the chip side of things, we also have AMD, which is also jumping into the space or playing more in the space. They're up 69% for the first half of the year. So a lot of these companies really talking about how they're going to use generative AI or how they're working to benefit the space and the players in that space. And it seems as though we've had the discussion of the benefits and the negatives, those of misinformation, disinformation, people talking about copyright works being used to train these models, just nonstop since the start of the year. And really, I think if you can talk about one big theme for 2023 so far, we're just about the 7 months in, it has to be AI.
Indeed, came up in all the earnings calls. We'll see if investors hone in as they try and get some specifics from some of these companies as to how they plan on using it more. Great stuff there. Thank you for that update, our very own Dan Howley. All right, taking a look at Bitcoin's ascent, that continues. It's still hovering above that key $30,000 mark and bringing the crypto market back to levels it last saw in March before a regulatory crackdown gathered pace. Now, investors are speculating, however, what new regulation could do to the industry, especially given that the SEC suits against several crypto exchanges are still active. Let's bring in now Unicoin president and founder Silvina Moschini. Silvina, good to see you here. So give us an idea of where things currently stand in the crypto space, especially now that Bitcoin is at that key level and seems to be maintaining it, at least for now.
Rachel, it's wonderful to see you. As you know, Bitcoin has died 500 times and it always comes back. And with all these developments on the regulatory side, we do believe that this will continue to be that way because it will bring a lot of investors, many investors that are not yet into the crypto space that will feel more comfortable, that will bring trust into the value proposition that the cryptocurrencies are bringing to the market. So we can only expect this to grow.
Now, there are a lot of different aspects, a lot of asset classes that come under the umbrella of crypto. Which ones are you tending to see investors pouring into more? Is it just about the tokens, the ones used for payments, or the ones focused on blockchain? How are you seeing some of that breaking down?
I think the technology, the blockchain technology, already left the stage. And so no doubt that the blockchain will bring a lot of opportunities. But when you come to see the crypto assets, the cryptocurrencies, what we're seeing more and more is that people are preferring the cryptocurrencies that has assets backing and that are transparent and that are protecting the investors. So more regulation, asset behind, no intrinsic values. You see, like, tokens like Frogcoin has peak on the market and go up and down because it doesn't have anything that are backing them. And we see much more growth towards better investment and transactional instrument value propositions that bring the best of the financial world and the best of blockchain technology.
And of course, along with the financial world comes the eyes of regulators. We saw from Federal Reserve Chairman Jerome Powell, he called for more regulation when he spoke with the U.S. House Financial Services Committee last week. And here's what he had to say, especially about stablecoins.
We do see payment stablecoins as a form of money. And in all advanced economies, the ultimate source of credibility in money is the central bank. And we believe that it would be appropriate to have quite a robust federal role in what happens in stablecoins going forward, and that leaving us with a weak role and allowing a lot of private money creation at the state level would be a mistake.
So I want to get your take on the Fed sort of stepping in, if it did come into that role with stablecoins, versus how we're seeing the SEC and other regulators trying to approach this.
I love it. And what I'm seeing is that what is happening is something similar to what it happened in the first .com revolution. I have the opportunity to be part of a .com company back in 2000, and is the evolution towards the generation 2, the second generation, where a much more contained framework, much better rules are here to stay, and the Wild West, in which we just, fortunately we gone through, in which there was no regulations and a lot of bad players have to change. So I'm very positive about this. I think it will bring trust into the market, and legislators need to learn more. They need to be prepared to participate more actively into this new development, but I'm very optimistic about this.
Now, one thing that did fuel some optimism, BlackRock making its efforts there for the spot Bitcoin ETF proposal here. If that does get approved, first, how likely is that, do you think, to get approved? And what will that open up for the crypto space?
I think it's very likely to get approved. Bitcoin was the best performing asset class of the last decade, and it will bring a new area, a new level of trust, and it will basically redefine when institutional investors get into something that was started by an anonymous person to bring anonymity, and now it's reaching to new heights by basically becoming the new norm, the next generation of crypto asset. It's only to be positive. And money evolves. Like, it was first sold gold, the barter of merchandises, then plastic and emails, and now is blockchain technology. So I believe that this will just start a new area, a new revolution into the crypto space.
And Sylvina, I know you were ahead of the game when you founded Unicoin. For people who are wondering then, where does Unicoin fit in with some of these other tokens and systems, and what does the next wave of crypto innovation look like? Where does it go from here?
Rachel, we took a leap of faith by going straight to a regulated public reporting cryptocurrency. We thought that this was going to become regulated because this is what happened in new industries. Like, they get started on the illegal side, like Uber, and then it becomes more regulated. So for us, it was about bringing something that people can trust, but also creating intrinsic value. So we move into development a very large portfolio. By now we have $500 million of pre-sales, and we are creating a real estate portfolio by swapping unicoins for real estate, and we plan to take it to exchanges this fall. So it's a proof that better financial industries can be created if you follow the rules, but you are innovative enough to find the spot where they need to be improved, and also have in mind how to democratize access to investment opportunities for people, bringing products that people can understand, that make sense, and that can be accessible for the majority of people who has even a small amount of money to participate in the wealth creation economy.
It's true, because when crypto was first starting, a lot of people thought, look, this is something to level the playing field, get the unbanked involved, get people who aren't perhaps represented. And I know you're one of the few women who I see on a regular basis who are really involved in crypto, not just as an investor, but also with your own coin. Talk about how much you've seen that grow. Are you seeing more women coming into crypto, both as investors and as also creators of value here?
I would love to tell you that I see a lot of women coming into the crypto world as entrepreneurs developing this type of solutions, but unfortunately we are behind. But what I see is that women are investing in crypto as the second asset class after fiat currency. So I'm very positive that it will break the barriers of that very sad relationship that women have with money and with the idea of owning it, and allow especially younger generations to embrace the concept of creating wealth. So I'm very optimistic. I think that, since Shakira, we are, as women, taking control of our financial future. We're making money instead of crying, and we hope that crypto will bring many opportunities for women to embrace that concept as well.
Certainly hope so. Really good to talk to you today. A big thank you there to Unicorn President and Founder, Silvina Moschini. Thank you so much.
Thank you.
Right, well, if you're feeling hungry, lab-grown meat could be coming to a restaurant near you. Upside Foods and Good Meat received grants of approval from the USDA to produce and sell their lab-cultivated chicken products in the United States. Amy Chen, Upside Foods COO, joined Shauna Smith and Akiko Fujita on the 3 to 5 show yesterday.
We call it cultivated chicken. So it's essentially the meat that you have always known, but made in a new way. So it's literally grown from animal cells. So we start with a sample of cells, we feed them nutrients, vitamins, et cetera, in what we call a cultivator. And after anywhere from 1 to 3 weeks, they produce meat that we can then harvest and formulate into any delicious product that you love.
Where do the animal cells come from?
So the animal cells can come from a variety of places. They come from the animal species, so a chicken. In our case, we started with a fertilized egg.
What about cost? Because that has been a huge issue when it comes to lab-grown meat, how costly it is to produce it. What does that look like? How does it stack up against what I guess most people call traditional meat?
Like any new innovation, whether it's electric vehicles or cell phones or anything in that era or in that genre, it will start at a price premium. So we will be launching in select restaurants with limited partners. And over time, we will be continuing to work on both scale and cost. So expect to pay a premium at the outset.
What does that mean in terms of a premium if you compare it to sort of a standard chicken dish? I realize these are going to be in restaurants, premium restaurants, but what kind of price tag are we talking about?
So at a restaurant, think about an organic or a free-range chicken. We'll be in the range of what you'd expect to pay for an entree at the restaurants where we launch.
Amy, how much of this can you make? I believe right now you're able to make small volumes of this, but scaling it to make larger volumes. What does the timeline look like for that and the cost of that?
It's a great question. So right now we're operating out of EPIC, which is our engineering, production, and innovation center. Out of that facility, we can produce anywhere from 50,000 pounds in its current configuration up to about 400,000 if we expand. We're simultaneously working on a commercial plant that will be able to produce millions of pounds. So the real vision and the impact is that everything we are doing is working towards scale, because that's what will ultimately allow us to have the impact that we want on the environment, on animal welfare, on human health.
So let's talk about that impact to the environment. I mean, what does the carbon footprint look like for cultivated meat? There's certainly been some criticism about just how energy intensive it can be to grow it in a lab unless you use 100% renewable energy. Is that what Upside Foods is doing?
Our current facility is powered by 100% renewable energy, but let me, Akiko, take a step back. So conventional animal agriculture is responsible for 15% of all greenhouse gases. It's a third of arable land and water, and we slaughter 70 billion plus land animals a year. So the impact and the scale is absolutely staggering. There have been a number of third-party peer-reviewed studies that have said at scale, expect with cultivated meat to reduce that footprint by as much as 90%. So it is a very meaningful impact.
And finally, you know, there's a lot of viewers who are watching this who aren't going to be near these restaurants where the initial tests will be carried out. How long until consumers will be able to find these meats in grocery stores?
I expect it to be a few years before it's grocery stores, although we're running a contest now, so consumers all across the country can actually, until midnight tonight, sign up to be amongst the first to try it in our restaurant launch at Bar Kren. But we'll be debuting in restaurants starting in San Francisco and expanding from there.
Amy, there's a lot to be excited about, but I think many people out there are a little hesitant. They don't know exactly what this is going to taste like. How do you get those people on board? What's your message to those that are saying, hey, I don't think it's going to taste anything like traditional meat?
I will tell you first, I'm a Texan, so I love my meat, I love my barbecue, and it's something that's very precious to me. I will share my own experience. When I first put this bite of cultivated chicken in my mouth, I thought, this is the most amazing, remarkable thing I've ever eaten. It didn't require an animal to be slaughtered. It could literally change the world. And then I chewed and I thought, it tastes just like chicken. And that's exactly what we hope for, that the future tastes as delicious as consumers expect their current meats to be, but in a way and made in a way that people can feel really great about.
Well, that was Amy Chen, their Upside Food COO, alongside Yahoo Finance Shauna Smith and Akiko Fujita. Right, everyone's racing to tune in to Formula One. The sport, which originated in the 1920s and 30s, is the highest class of international car racing. It's grown significantly since its inception, including more races per season. With that in mind, recently Alpine, the sports car division of the French manufacturer Renault, secured 200 million euros from a group of investors. One of its high-profile investors was Hollywood actor Ryan Reynolds, who was also invested into Welsh soccer club Wrexham AFC. Now, given Reynolds' success with Wrexham AFC, people are eyeing his investment into the racing car manufacturer as well. Formula One Group revenue hit $2.6 billion in 2022, and large investments into cars are expected to bring in even more brand value and higher pay for drivers. That's according to Renault Group CEO. All right, all your markets action still ahead. Stay tuned. You're watching Yahoo Finance.
The AI stock bubble will burst when it bursts, and you will not be able to tell when the stock bubble bursts. I'll say this, if you see AI stocks like C3 AI and Salesforce going down for, 10 straight days, the bubble has probably burst.
We're almost midway through the calendar year and stocks define expectations in the first half of 2023. But with sky-high inflation and rising fears of a potential recession, investors are searching for the most promising industries. Jill Malandrino, Nasdaq Global Markets reporter, joins us now. Good to see you, Jill. I mean, we're seeing inflation moderating, but consumers are still feeling the pinch of higher prices. What will happen when consumers do run out of their pandemic savings?
Most of that money has been spent as the savings rate has dropped from an average of around 9% before the pandemic to around 3% in the final quarter of 2022. Many households still have more cash on hand now than they normally would want, but how much of that will they spend as the economy slows? One possibility is that many consumers will remain cautious and hold on to those savings even as they are able to go out and spend. Another possibility is that spending booms for a while longer as post-pandemic revenge spending on travel and consumer services continues to grow. Deloitte analysts forecast continued job and income growth will support sustained growth in consumer spending, but spending will slow as the savings rate eventually rises back to the 6% range. While spending on services has continued to gradually expand, spending on goods has been volatile. Recent PMI data suggests that the services sector is beginning to cool. The Conference Board expects high interest rates to further dampen spending on goods and forecasts that overall consumer spending will grow in the second quarter of 2023, but anticipate a contraction in the second half of 2023. During economic downturns or recessions, in this case, a recession that has yet to materialize, consumer staples tend to perform relatively well because they are essential products and would be considered defensive investments. That said, consumers may be more sensitive to further price hikes than they were to the past price hikes that took place in 2022, particularly if the economy softens further and the unemployment rate rises. Those best positioned for this backdrop may include companies that can raise prices further without losing sales volumes. Analysts at Fidelity point out two bright spots. Consumer staples companies with exposure to emerging markets could also be well positioned to weather any further economic storms in 2023. Many of these countries have a fast-growing middle class, leading to higher per capita growth in developed markets. Plus, many emerging market nations have been battling inflation for decades, which means consumers are used to seeing prices rise and less likely to change their purchasing decisions in reaction to price hikes. Finally, consumer staples companies that make private label products may hold up well as their lower price points attract consumers.
And Jill, we've really seen the tech stocks rallying this year and sort of lifting the rest of the S&P with it, but with the tech-heavy Nasdaq Composite up about 28% year to date. So what can we expect from the sector later this year?
Yeah, I mean, it certainly has been quite a year for the Nasdaq 100 in particular, which doesn't have financial exposure, which is why we tend to see it go a little bit higher than the composite. Virtually every company in every industry is now looking to use technology to get closer to its customers, innovate more quickly, and operate more efficiently. Many firms are embarking on multi-year digital transformation projects, and this may only accelerate as companies adapt to hybrid work environments. Companies that provide the technology to aid in these transitions could be potential beneficiaries of this trend. That includes the cloud, generative AI, and ML. Increasing adoption of cloud computing continues to be disruptive influence as enterprises shed their in-house hardware-based architecture in favor of cloud-based systems. And because of these hybrid environments and adding additional layers to the tech stack, the case for cybersecurity spend can certainly be made, and why the CISO, known as the Chief Information Security Officer, is increasingly finding a seat at the table of the board to bridge the gap between security needs and finances. In fact, your CISOs are reporting it to the CFOs at this point. Gartner predicts that by 2025, lack of talent or human failure will be responsible for over half of significant cyber incidents, and the consumerization of AI-enabled fraud will fundamentally change enterprise attack surface, driving more outsourcing of enterprise trust and focus on security education and awareness. Microsoft, the biggest investor in OpenAI, has launched Security Copilot. Copilot's AI assistant helps cybersecurity professionals use prompts to make sense of threat intelligence and investigative incidents. Palo Alto Networks leverages threat detection logs in its AI-based security operations center platform. CrowdStrike has equipped its Falcon platform with AI capabilities. There are also a number of cybersecurity startups in this space. Global cyber spend is expected to reach $219 billion in 2023 and grow to nearly $300 billion in 2026, according to IDC. Software, the fastest growing segment, will capture 47% of all cybersecurity spending this year, followed by services at 39% and hardware at 13%. And of course, this is according to IDC's forecast.
And of course, all this generative AI really sort of kicked off with OpenAI and Sam Altman there. And according to sources at The Information, they might be planning to turn ChatGPT into its own co-pilot, essentially potentially being a rival for Microsoft and some of these companies that thought they were going to just benefit from ChatGPT. How do you think that might change the mix?
You know, it's interesting when it comes to ChatGPT because companies are leveraging it in different ways that fits their needs based on, you know, client profiles and what they're trying to do with it at the end of the day, right? So it's about all the input that goes in and how they're leveraging the output that comes out. So a technology company might use ChatGPT in a certain way or whatever generative AI platform they decide to leverage versus an industrial company, manufacturing company, healthcare company. They have different needs for different types of clients.
So certainly a lot of room. Everyone has some room here. As you mentioned, there are different needs and different size companies as well. A big thank you there to Jill Malandrino there, Nasdaq Global Markets reporter. Thank you so much. All right, stay with us. The race is on to develop a new generation of weight loss drugs. Pharma companies Novo Nordisk, Eli Lilly, and Pfizer are all competing to seek FDA approval of a first-in-class oral weight loss and diabetes drug. For more on the hot obesity drug market is Yahoo Finance's Anjali Kemlani. Hi, Anj.
Hi, Rochelle. Yeah, a lot of news actually came out yesterday. It seems like they're all really head to head here with this news. We know that Pfizer decided to pick one of its two candidates in the pipeline to advance to phase 2. And that is one that disappointed investors with the twice daily option. They are still working on a reformulation. Meanwhile, Eli Lilly over the weekend out with its update on its pill, showing that it has pretty strong weight loss potential and strong just results in general in its phase 2 to move on to phase 3. Meanwhile, Novo Nordisk out with its pill that is already proven for type 2 diabetes, but it does have some it does have some clinical trials in the works in order to test a higher dosage of that. And we saw some positive results there as well. So, comparing all of the weight loss ratios that you see, it's really somewhere between 12 to 24 at this point for injectables and pills alike. And that's something that is an area to keep an eye on because this drastic difference in weight loss and also what it's targeting, whether for type 2 diabetes patients or obesity patients, is an area where they're all competing really fiercely right now.
And as you mentioned, you have the shots and the pills. You also have sort of the efficiency and how quickly you can lose weight on these different things. So Anjali, are there any other updates in this space that you're tracking?
Yeah, so it's really important to look at all the different types of formulas, essentially. So the class of drugs that we've been talking about so far have been GLP-1. So if you look up anything about that, that's your Ozempics and Mounjaros and the like. Eli Lilly just came out with another result yesterday, late in the day, showing that its retatrutide, I'm going to say that wrong, so whatever that is, 24% weight loss there. And that is a combination. It's not just a straight GLP-1, and it's showing much stronger results than Mounjaro, its own weight loss drug for type 2 diabetes. So, not only are these companies competing against each other, but they're essentially also competing against themselves for stronger and better formulations as this area heats up. We know that now that the conversation surrounds obesity as a chronic disease, you're going to really see more of this with these companies coming back to back with products, not only competing with each other, but also themselves.
Indeed. Also, want to shift gears just quickly and talk about Walgreens. They were out with results this morning. What should we focus on there?
Yeah, a little bit of a slip there on the revenue. We know that, the guidance, the outlook for the rest of the year, something kind of expected. We've been hearing from all these pharmacies as a result of the reduction in the business of COVID vaccines. But I think one thing to keep an eye out for is what they're doing with their health segments. We know, for example, competitor CVS also coming in really strong on the health segment, making moves. So there's a lot of competition in that space right now. Walgreens is also in the clinical trial space, which CVS backed out of. So they're also developing a new business segment there. So a lot of different moving parts here when it comes to what you can expect out of, your traditional pharmacy. Just to look at the numbers, earnings per share was expected to be $1.07, came in at $1. And then revenue was a little bit higher, $34.24 billion, expected, but actually came in at 35.42 for the quarter. So a little bit on the upside there, but definitely something to look out for and how they right size from the loss of the COVID business moving forward.
Certainly a lot of people looking for answers. Walgreens still our top trending ticker so far this morning. Big thank you there to Anjali Kamlani there for us. All right, well, let's get you a final check of the markets before we go. Still looking at positive gains here. Some buying action picking up. The Dow now up more than 155 points. They're about 0.5%. S&P 500, they're also up about 0.7% or 30 points. And the strongest gainer of the day, the Nasdaq, up 130 points or just over 1%. Well, that does it for now. I'm Rochelle Akufo, but I'll be back with you at 11 a.m. Eastern tomorrow. I'll see you then.